Welcome to Acera's pre-retirement seminar. In this seminar, I'm going to tell you all the things that you might want to know in the 3 years leading up to retirement, or maybe even the 3 months or 3 weeks leading up to retirement, depending on how far out it is for you. Because you're going to retire soon, and you probably have some questions. Questions like, what do I need to know? What do I need to do? Is there anything that I need to do? Well, we're going to get those questions answered for you today during the presentation. We'll get all your questions answered. To make it easy for you all to understand all of the information I'm going to tell you, because it's kind of a long seminar, it's 3 hours. What I've done is I've broken it up into these chunks and put them on this checklist. Okay, so this is your pre-retirement checklist. I'm going to help you understand your membership. So we'll talk a little bit about your contributions to Acera. We'll look at your retirement timeline, and we'll talk about your tier. Okay, then I'm going to help you get an estimate of your retirement benefit. So you can follow along with me during that if you want to, or you can simply kind of take notes and do it later, but I'm going to show you how to get a retirement benefit estimate. And in doing so, I'm going to tell you about the retirement formula that we use to calculate your retirement allowance that you're going to get when you retire. We'll talk about briefly about purchasing service credit. I'll tell you how vacation affects the salary component of the retirement formula, which is something that people have lots of questions about. So we'll dig into detail about that topic. And then I'll show you our benefit estimator tool and give you an example. Okay. In the second half of the presentation, I'm going to help you verify your retirement eligibility. And I'm going to help you choose your retirement date. And then I'm going to tell you about the process that you're going to go through to apply to retire. Okay. And we'll talk about the 5 different retirement allowance options, because you're going to choose one of these options when it's time to retire. I'll tell you about medical, dental, and vision benefits. We'll talk a little bit about understanding life events, and then about signing up for Acera News. Okay. So we have a lot of information to get through. So let's go ahead and get started. Let me help you understand your membership, first of all. So who is Acera? Acera is the Alameda County Employees Retirement Association. Okay, so it's this acronym. But really, it's an agency, and we're made up of people. There's about 90 of us that work here. And what we do is we provide retirement, disability, and death benefits to all of our members. So that's you. You are also part of Acera because you are a member of Acera. So Acera is the people that work here and all of you. And you're a member of Acera because of the position that you work in and who you work for. So you work, or at some point you worked full-time in a retirement eligible position for one of our 6 participating employers. These are the public employers in Alameda County that have partnered with Acera to provide retirement benefits to all of their employees when they retire. Okay. And as a member of Acera, or let me rephrase that, as an employee working in one of those full-time retirement eligible positions, you automatically become a member of Acera. Okay. So your membership is automatic. And as a member of Acera, you contribute to Acera's fund with every paycheck. So if you look at each paycheck in the before tax deductions column, you will see a line that says retirement, and there's some money that comes out of your check, and that goes into Acera's fund. And your employer also makes contributions on your behalf. Okay, and they typically contribute a little more than you do. Sometimes a lot more, depending on your position. So then we have this money, and we don't just want it to sit there and lose momentum due to inflation. So what we're going to do is we invest that money all over the world, and we earn a lot of interest on that money. So these 3 sources of income, you contributing, your employer contributing, and the investment earnings, give us this big pool of money that we're working with here that we call Acera's fund. Okay, so what do we do with that money? So meanwhile, you are working, and while you are working, you're earning credit toward retirement. So while during your entire employment, you're earning credit toward retirement. And then at some point in the future, you're going to retire, and then you're going to start collecting that retirement that you earned. And you're going to collect it every month for the rest of your life. It's a lifetime retirement allowance paid on the last business day of each month. So it's an amazing thing because it's an amount of money that you can count on, that you earned, and you can count on it for the rest of your life, plus cost of living increases annually. So that retirement allowance is also known as your retirement benefit or your pension benefit or your pension. These are all kind of synonymous terms for that lifetime retirement allowance that you can count on. Okay, so sticking with the topic of pension basics and understanding your membership, let me show you this chart of pension milestones that you will experience during your membership with Acera. First off, we have your date of hire. So that is the first day that they told you to show up to work if you started out in your full-time retirement eligible position. If you didn't, if you started out in working for your employer in some other capacity, this would be the first day that you worked in that full-time retirement eligible position. Okay, then for most people, what happens is 2 weeks goes by, and the first day of your second pay period, that is your first day of Acera membership. That's the day when you enter Acera membership, also known as your date of entry. Now, there's a couple of employers. I think it's Livermore Area Recreation and Parks District and the Housing Authority, where your date of hire is actually your date of entry into Acera. So there is no 2-week gap. But for everyone else, there's that 2-week gap before you enter Acera. And when you enter Acera, that is when you start earning that credit toward retirement while you work. Okay, then 5 years goes by. And after 5 years working full-time or the equivalent of full-time, you're considered vested in the retirement system. Now, that word vested gets thrown around, and you may have heard about it. It's pretty basic. All it means is guaranteed. Okay. So when you're vested in the retirement system, that means once you've achieved that vesting, you're guaranteed the vested benefits that are in the system. So you're basically guaranteed the guaranteed benefits once you reach vesting. So that's simply what that means. Okay, then some point after you're vested, you will achieve retirement eligibility. So you will actually become eligible to retire. And it's based on some combination of your years of service credit. So basically how many years that you've worked, and your age. And some combination of those gets you to retirement eligibility. And I'll tell you the details of that in the presentation. Okay. Once you're eligible to retire, you can retire on that day if you want, or you can stick around, work some more, earn some more credit toward retirement. And then at some point in the future, there's going to be a date that you choose that is your retirement date. Okay. So we don't pick your retirement date for you. You tell us when you're done, you're ready to retire. You pick that date, and that's your first day of retirement. And that is when you stop earning retirement and start collecting retirement for the rest of your life until your death. So that's when your retirement payments will stop. But then there is an additional milestone on this pension milestone chart. Depending on which option you selected at the time of retirement, many of the options will provide for a continuing monthly payment for one or more beneficiaries after your death. And in most cases, that will go for the rest of their life. And so when they die, that is when their beneficiary payments would stop. So a continuance, it simply means a continuing payment. We'll dig into all the details of all of these things throughout the presentation. But I just wanted to give you kind of a high-level overview of the pension milestones. Okay, at this point, I would like to introduce you to the worksheet. Okay, so this is your retirement planning worksheet. This right here, what I'm showing you is just one of the boxes on the worksheet. Let me switch over to the web and I'll show you where to get the worksheet. There was a link to it in the email that you received, but if you didn't catch that, no worries. I'll show you exactly where to get that worksheet. So you go to acera.org and you go to under news and events, you go down to retirement planning seminars. This is the exact spot that you use to sign up for the seminar. Okay, you scroll down under webinar options and click on pre-retirement webinar to expose that information. And it's right here. Okay, the retirement planning worksheet. It's a PDF. And this is your takeaway. We created this because it's kind of a long webinar, and we were noticing that people would come back and go do the webinar again, or I mean, when we were doing them live, come back to the seminar again, because they didn't, it's kind of hard to retain all that information. So this is kind of your takeaway. As we go along, feel free, as you discover what these numbers are for you, for your own individual situation, you can write those in the worksheet. And then later on, when you come back and you try to kind of remember what you learned in the webinar, then you can look at the worksheet and go, oh, okay, now I remember my entry date, vested date. Oh yeah, and I was kind of projecting my retirement date. I remember my tier, all of that. Okay. So to start off with, and you can, what you're going to want to do is go ahead and download this. So you would want to click the download button and download that to your machine. And then you can fill out the fields electronically if you want to, or you can print it out and do it in pencil or pen. Okay. So I'm just going to start off with this My Career Timeline segment of the worksheet. So let me switch back over to the presentation where I have that screenshot. Okay, at this point, since you understand what your ACERA entry date is, it is most likely 2 weeks after your date of hire, or for LARPD and the Housing Authority, it's your date of hire into your retirement eligible position. You can write that in. Now, that may be a long time ago and you don't remember exactly what it is. That's totally fine. I've written approximate dates up here because, if you just want to approximate what that is, if you remember it's in like November of 2003, go ahead and write it in there. It's not a huge deal. If you did want to know your exact ACERA entry date, you can always find it in your account on our website if you log into your account. Okay, and at this point, if you want to, if you already have a projected retirement date in mind, you could go ahead and pencil that in here. But I say pencil it in because you may learn something during the webinar that will make you want to adjust your date a little bit. Okay, so you can do that at this time. Okay, really quickly, a little more about vesting. Like I said, it happens after 5 years of full-time service credit, but that also includes reciprocal service credit. If you have reciprocity with a different retirement system that you've linked together, it's the service credit from all the systems combined gets you over that 5-year mark. And the guarantee part of the vested, I said vested means guaranteed, that is guaranteed by state law. So it's state law that has allowed the county to establish ACERA and tells us how to run the retirement system and provide you the benefits. And the vested benefits, the guaranteed benefits, are that monthly retirement allowance for the rest of your life once you retire, an annual cost of living increase to that retirement allowance, and a $1,000 lump sum death benefit. Now, there are other death benefits that will be available, which I'll show you depending on the different retirement option you select. But this is like a basic $1,000 lump sum death benefit that's just guaranteed. Okay, and then there's a question. I started working part-time for 7 years and then converted to full-time. What is my ACERA entry date? Your ACERA entry date is going to be when you converted to that full-time position. Most likely, if you didn't start out working full-time, you weren't eligible to enter ACERA yet. So then your entry date would be when you got that full-time position. Okay. Now, to verify that, like I said, go log into your account on our website and it will tell you your exact entry date. And then most likely that part-time work, as long as that 7 years of part-time work, as long as it wasn't under contract or for a temp agency or for an employment agency, if it was just plain old part-time, that will be purchasable. And so you could purchase that. Okay, you already bought them. Great. And we will touch on purchasing service credit in a little bit. Okay, so now that you know what your vested date is, it's simply 5 years after your entry date. You could just add 5 years to your entry date and put the vested date in there. The vested date isn't super important in most cases because most people have way more than the 5 years, but you can just put it in there if you like. Okay, now also sticking with the topic of understanding your membership, we'll talk about your tier. You all are in one of these tiers. If you're a safety member, you may have 2 tiers, okay? And your tier is based on your date of entry. So to find yourself on this tier chart, to find which timeline you're looking at, first you're gonna look at whether you're a safety member or a general member. Safety members, you know who you are. You are sheriff's deputies and probation officers, and there may be some other sworn officers in there. Okay, so you're gonna look at this bottom timeline. Everyone else is a general member. So you're going to look at the top timeline unless you work for the Housing Authority or Livermore Area Recreation and Parks District, and then you'll look at your appropriate timeline for your general membership for your employer. Now, the way this works is if you entered ACERA before each one of the cutoff dates, that puts you in the earlier tier. So if you entered ACERA before July 1st, 1983, that puts you in tier 1 for the general members, okay, and also for the safety members. Now, if you entered ACERA on July 1st, 1983, all the way up to December 12th, 2012, I'm sorry, December 31st, 2012, that would put you in tier 2 for the general members, for example. And then January 1st, 2013 and beyond is tier 4 for all of the different employers and tiers. Housing Authority and LARPD have a couple of different cutoff dates for their tiers. LARPD has tier 3 and not tier 2, so be cognizant of that. And then for the safety members, if you entered a SARA between October 17th, 2010 and December 31st, 2012, you had the choice of tier 2C and tier 2D within the first 45 days of your membership. And you made a choice. If you don't remember what choice you made, you can always log into your account on our website and it will tell you which one of those tiers you're in. Okay, now you know what tier you're in. That's going to help you understand some of the other information I'm going to tell you later on in the presentation. And there is one question here. I started working with a TAP program and then was hired. What would be my entry date? Your entry date is always going to be 2 weeks after the first day in your full-time retirement eligible position. So TAP, the county's temporary assignment pool, is not a full-time retirement eligible position. So it would be your date of entry would be 2 weeks after your date of hire in that full-time retirement eligible position. And again, TAP time is purchasable. One more question. If I did part-time during tier 1, but then started doing full-time during tier 2, and I buy the service time for the part-time period, am I tier 1 or tier 2? You're going to be tier 2 most likely, because if you were working before that July 1st, 1983 cutoff date and it was part-time work, you weren't an SARA member yet until after that cutoff date. And because your membership didn't start until after that cutoff date, that would put you in tier 2. And you can buy that time, but you're still going to be in tier 2. Okay. Now you know what tier you're in. Go ahead and mark that on your worksheet. Now, for safety members, you may have actually done a little bit of general work at some point in your career. So you may have some time as in the general tier and some time in the safety tier. You could mark both on your one worksheet, or you could do 2 separate worksheets if you want to. Okay. And the way the calculation is going to work when you go to retire is we're going to do kind of 2 separate calculations. We'll do one for your general membership and one for your safety membership. Both will give us a dollar amount. We'll combine them and send you one check. Okay. So we covered understanding your membership. Let's get into the topic of estimating your retirement benefit. Oh, and let me answer this one more question about tiers. So the question is, you indicated that tier 1 is membership prior to July 1st, 1983. Okay, tier 1, so I think you're maybe I wasn't clear on the dates. Tier 1 membership is if you entered a SARA before July 1st, 1983. Okay. Now, tier 2 is if you entered a SARA between July 1st, 1983, all the way up to December 31st, 2012. Okay. That puts you in tier 2. And it sounds like you might be in tier 2. And then tier 4 is January 1st, 2013 and beyond. Okay. Gotcha. Yep. You're welcome. Okay, so before I tell you how to estimate your retirement benefit, it's going to be way easier if you understand how we calculate your retirement benefit. Okay. So I'll explain to you this formula that we use to calculate your benefit. Okay. So you have the age factor percentage, the year. Okay. Let me start over. This is the formula that we're going to use to calculate your retirement when you go to retire. Okay. Now, this is kind of the English explanation of the formula. When you go to retire, you're going to get a percentage of your highest salary for each year of service that you work. Okay. So let me break that concept down for you in terms of this formula. Let's say that the percentage of your highest salary that you're going to get for each year of service that you work in your career is 2%. Okay. And let's say also that you work 20 full-time years, or the equivalent of 20 full-time years during your career. So according to this sentence, you're going to get 2% of your highest salary, that your working salary while you were working, for each one of those 20 years of service that you work. That means because you're getting 2% for each of the 20 years, you're getting 40% of your highest salary when we multiply those together, okay? And let's also, to stick with this example, let's say that your highest average monthly salary during your career is $5,000 per month. Your retirement allowance is going to be 40% of that, okay? So 40% of $5,000 working salary is $2,000. So we just multiply the 40% times the 5,000 to get the $2,000. So that is the way that we calculate your pension, and your, also known as your monthly retirement allowance. Okay, so let me tell you a little bit more, a few more details about each one of the factors in the formula: the age factor percentage, the service credit, and the salary. So it'll help you understand how your retirement allowance estimate a little bit better. First, I'll do the age factor percentage. The way we arrive at which age factor percentage that we're going to put in the formula for you is based on this chart, because it's not going to be 2% in all cases, only in a few cases. It's actually going to be based on your age at retirement, okay? And so this is a sample of the chart that we're going to use in order to determine what percent of your highest salary you're going to get for each year of service, okay? So the way this works is you're going to find your tier on here, and you're going to forget about all of the other numbers. So if you're a general tier 2 member, you just look at this column. A general tier 4, look at this column. You know, safety tiers, find your tier in here. You just look at the one column, forget about all the other columns. Okay. Now, let's say you're a tier 2 member and you're going to retire at age 60. What we do when you go to retire is we say, okay, you're a general tier 2. We're going to retire at age 60. You're going to retire at age 60. And so we come over to this chart. We go down to age 60 for general tier 2, 1.92%. That is the percentage that we're going to put in the formula for you. That is the percent of your highest average salary that you're going to get for each year of service. Okay. Now you'll notice a few things about this chart. One is that the numbers get larger the older you are when you retire. Okay. So the ages get bigger in this column. The percentages of your salary that you're going to get bigger, up to a maximum for your tier. So for each one of the tiers, there's a maximum age factor percentage you can get in the formula. So for example, tier 2 general members is 2.43% at age 65. So if you retired at age 65 as a tier 2 general member, that's what the percentage we would use for you. If you retired at 66 or 67, it'd be 2.43%. Okay. So if you retire over that age, you just get the maximum age factor percentage for your tier. You may also notice that there are a bunch of gaps in the ages. And that is because there are too many incremental increases in the age factor percentages, because they actually increase every quarter year that you age. So if this were the full chart, it would say 52, 52 and a quarter, 52 and a half, 52 and 3/4, 53, and so on and so forth. And there would actually be an incremental increase where the age factor percentage would go up with every quarter year that you get older and don't retire. Okay. If you want there, and there's too many to fit on the slide. So if you want to see what all those are, you can find those on our website. Okay. And the 3 months, that's based on your birthday, because you're aging every 3 months is based on your birthday. So if your birthday is January 15th, 3 months later is April 15th. So you pass that date, you go up one notch in the age factor chart. You pass July 15th, you go up another notch. So, October 15th, you go up another notch. And there's a slightly increased increment for each age factor percentage for each 3 months. Okay, so let's see, what else do I want to tell you about this? Okay, so the question is, there's a question on the board. Is it over the fiscal year or the calendar year? It's neither. It's based on your birthday. So however your birthday is, so if your birthday was January 20th, then 1/4 would be April 20th. If your birthday was February 20th, 1/4 after that would be May 20th, and so on and so forth. Okay. So I think that's all I have to tell you about the age factor percentages. Let me move on to the next factor in the formula, which is the service credit. Okay, let's talk about service credit. You start earning service credit when you enter a SARA. So like I said, as you work, you earn service credit. So that starts on your date of entry. And then you're going to earn service credit all throughout your entire career all the way up until you retire. And that is assuming that you're going straight from active work into retirement. Now, if you don't, some people don't, you stop working and defer your retirement to a later date, then you would stop earning service credit whenever you terminate your employment. Okay, so there would be an extra milestone in here, which is termination date. But you're going to earn service credit the entire time that you're working. Okay, now, what types of, okay, so when do you earn service credit? Let me just phrase it that way. You earn service credit during your regular working hours. You also earn service credit during your earned leave time. So earned vacation, sick leave, management leave, comp time, holidays, floating holidays. You're earning service credit during all of those times. Those don't count against you, okay, in terms of earning service credit. So you go out on your vacation, go out on your sick leave, floating holidays, everything, you're earning service credit during those times. Now, the times when you're not earning service credit is any time that you go out on leave without pay, you're not earning service credit during that time. If you're not getting paid from your employer, you're not earning service credit. Also, if you purchase additional vacation on top of your earned vacation, you do not earn service credit during that purchase vacation time. When you're marking purchase vacation on your timesheet, you're not earning service credit during that time. And it's not purchasable later. So, but it's not a big deal if you are missing a week here and there because of purchase vacation. It's not really going to affect your retirement allowance, but pennies probably. So don't worry about it. Now, sold vacation you do not earn service credit for that. If you earn vacation, you sell it back to your employer while you're still employed, you don't get service credit for that, but you could get salary credit for that in the salary component of the formula. And we will take a deep dive into that when we talk about salary in just a minute. You also don't get service credit during overtime, on-call time, or standby time. Okay. Let's see. I have a question about salary, when you're in salary. I'll cover that in just a minute. Okay, there's a question. After I turn 62 in tier 1, my monthly amount will not increase, correct? Not correct. Because remember, it's a 3-factor formula. It's a multiplication. So the higher, let me go back to the formula. The higher any of these 3 numbers are, the higher your retirement allowance is going to be. So if you're tier 1 and you hit 62, yes, your age factor percentage is going to stop increasing. But if you keep working, you're going to earn more service credit, and probably your salary over the years is going to increase through cost of living adjustments and perhaps raises. And so those components of the formula will increase. And the higher any of the 3 components of the formula are, the higher your retirement allowance is going to be. So just because you hit the maximum age factor percentage doesn't mean you're done earning more credit toward retirement, because you're earning credit. Even though this one is called service credit, you're kind of earning credit in all of these 3 categories. You're earning credit by just getting older and that number going up, by working and earning more years of service credit, and by earning higher and higher salaries. Okay. Let's see. Okay, so we have some more questions about service, when you earn service credit. Okay, so there's 2 questions about different types of time that may be purchasable. So there's a question up there about workers' comp time, and there's a question about disability time and maternity leave. Okay, so while you're out on workers' comp time, often what happens is you're paid partially from your employer and you are paid partially from the workers' comp system. And the same thing, I think, with disability, that may happen. Any portion where you're being paid by your employer, you're already earning partial service credit for. Then the other part where you're being paid by the state, you're not earning service credit for that, and then that becomes purchasable. Okay, so the disability and workers' comp time, that becomes purchasable. Okay, so that portion of the time. And then for maternity leave, that would fall under unpaid medical leave. So this is an example of the different types of time that you can purchase to increase your amount of service credit in the formula for you. Now, purchasing service credit, it doesn't change your date of entry. It doesn't change your date of retirement. All it's doing is simply changing the amount of service credit we're putting in the formula for you. And so some examples are part-time work done before your full-time retirement eligible position. Like I said, not for temporary agencies, not for under contract, just plain old part-time. That's purchasable. The county's temporary assignment pool time is all purchasable. Project work and there's some other categories in there of work that you may have done for your employer before your full-time retirement eligible position is purchasable. The 2 weeks between your date of hire and date of entry is purchasable. The unpaid leave time, as long as it's unpaid medical leave for your own medical condition, not a family member, unpaid leave for disability time, or military leave. When you return from these leaves, then you can make the purchase. Also, redeposits of prior membership. So if you used to be an ACERA member in the past and you took a refund of your contributions whenever you quit working, and now you're back and you want to put that money back in to get your service credit back that you originally earned, you can do that, and that's called a redeposit of a prior membership. There's also something called a redeposit of community property. So if you, because California is a community property state, if you get divorced or dissolve your domestic partnership, and you were married or in the domestic partnership while you were earning credit toward retirement, that credit toward retirement is community property, and that is often divided to an ex-spouse. Now, if that ex-spouse, if we divide it off into their own account and they take a refund of their account because part of your contribution account goes to them, they take a refund, we'll notify you that happened by sending you a letter in the mail, and then you have the opportunity to kind of repay that money, and that's a redeposit of community property to get your service credit back that was divided off to your ex-spouse. And then if you did work for another California public agency, that can be purchased as a SARA service credit as long as you're not eligible to collect a pension under that agency. So you would have to take a refund of any contributions you have on deposit with those other agencies. I'm not going to take a deep dive into purchasing service credit in this presentation because it's kind of a whole topic. I do explain that in detail during our new employee / mid-career seminar. And so if you want to go check out one of our videos on that on our website, it's kind of toward the beginning of the presentation. I do go into detail about purchasing service credit. Let me see, and I do have a few questions up on here. And then there's a question about working for the same agency, but through a contractor. Usually if you're under contract, that's not purchasable time. Okay, that's very, very rarely purchasable time. If you want to know more about that and you want to dig into that further, I suggest contacting ACERA by going to acera.org/contact, and we have an email form that you can fill out in there. To email us. Or you can call us at 510-628-3000. And that number is out on our website. So again, it's 510-628-3000. And we have a call center, and their entire job is to answer your questions. So they're experts on a lot of this stuff. Oh, and if you want to learn more about purchasing service credit, we do have an extensive webpage about that at acera.org/purchase. One more thing I will touch on regarding service credit, though, is what happens to your unused sick leave. So if you go straight from active work into retirement, and I have a calendar example here showing you that your last day on payroll, this is the date that you write on your letter of resignation, is the day before your retirement date. Another way to say that is your retirement date is the next day after your last day on payroll. Then that means you're going straight into retirement. There's no gap here, okay? If you're going straight into retirement, we can convert your sick leave to service credit. And it's okay if you're on leave, vacation leave that day or comp time or whatever, that's fine. It's just like, this is your last day on payroll. The next day is your retirement date. That means you're going straight into retirement from active work. And we can convert your sick leave to service credit on a 2-to-1 basis. So we'll take your sick leave that you have left on the books up to a cap, and the cap is in your memorandum of understanding, which is what MOU stands for. And we'll divide it by 2, and we'll give you additional service credit for that amount. So to give you an example, a lot of the caps and a lot of the MOUs are 125 days of sick leave. And if you've never seen your memorandum of understanding, you can ask your human resources department to look at it, and they'll tell you what the cap is. But a lot of them have 125 days of sick leave maximum that is convertible to service credit. Okay, so if you had 125 days or more of sick leave on the books and that was your cap, what we would do is take 125 days worth of sick leave, divide it by 2, and then you get 62 and a half days of service credit, additional service credit added to your service credit amount. And again, this does not extend out your retirement date. This just increases your amount of service credit. Now, this is working days. This is not calendar days. So 62 and a half working days would be about 12 plus work weeks if you're working 5 days a week. And that would be about 3 more months of additional service credit. So that can be a nice little boost to your service credit amount in the formula for you. Okay, now let's see here. Now, if you're unrepresented, is there an MOU? For unrepresented people, there is no cap. And for ACMEA, I think unrepresented people follow ACMEA. And because ACMEA has no cap, that's like the managers union, there is no cap. That's the only one I know off the top of my head. For the other ones, you're going to need to look at your MOU. Okay, let's see. Okay, and then there's a question. My understanding is that unused sick leave is no longer allowed by the Superior Court to be converted to service credit. Is this true? It could be. If your MOU says no sick leave is convertible, then we can't convert it. Okay, so you would definitely want to check with your employer and check your MOU. Okay. Is there a way to find out how much purchasable time I have available to me? Yes, what you're going to want to do is go to our website, log into your account, and go under web forms, and there's a purchase request form in there, and we'll ask you questions about different types of time. I think the main thing that you're going to want to do is look at this page on our website, and there's more details about there's more examples of different types of time for service credit, and you'll kind of understand more. You got to think back on your career if you have any of those types of time that are purchasable. And then you'll be able to ask kind of more incisive questions to perhaps your employer or to perhaps a Sarah to like look at your records to see if you have purchasable time. And then you would fill out a purchase request form to make that request to really determine whether that time is purchasable or not. You all hang on for 1 second. I'll be back in just 1 minute. Okay, I'm back. Sorry about that. Okay, now there's another question, sick leave accrual of 3 days a year or the larger PTO. Okay, so but based on that question, I'm guessing that you are in Alameda Health System. So sorry I didn't address you all earlier. So if you're in Alameda Health System, you don't really earn sick leave like everyone else does. You earn PTO, which is one bucket of like sick leave and vacation leave all combined. So your PTO is not going to be convertible here, but they will cash you out for it. So you'll get cash for it, and it can be used to increase your salary component of the formula, which I'll talk about. Now, there are a couple of types of sick leave for Alameda Health System people that are purchasable. Let me go to that page real fast, acera.org/purchase. There's actually a little pull down for you all. Let me see here. Sorry, I'm not finding it immediately. Oh, I think it's actually under earning and purchasing service credit. Okay, so then how about some unused sick leave? So here we go, AHS. Extended sick leave, that's what I was looking for. You all earn, if you have extended sick leave or intermittent sick leave on the books, when you're left over, that is convertible to service credit. But the PTO, that's not going to be convertible to service credit. But like I said, you will be able to get salary credit for it, perhaps. So I'll show you that in just a minute. Okay, so let me see if I have any more service credit questions here. Okay, there's a question. I wasn't aware about purchasing time back until a couple of years after I started working full-time. After inquiring about purchasing it, I was told I had 1 year to purchase after starting full-time or I could no longer do it. Okay, so that is this, that's kind of like this very this very kind of in the weeds subtopic about declaring intent to purchase certain kinds of service. What I recommend for that is you go ahead and write into, or if you can stick around after the presentation, I would be happy to answer that question and dig into that. Otherwise, if you don't have time to do that, I would go ahead and write into our customer service department at acera.org/contact, or go ahead and give them a call and they can give you more information about that. Okay. So, yeah, sorry, it's kind of like in a bit of an in the weeds topic that takes a long time to explain and doesn't kind of broadly apply. So, or I could answer it during the break time if you like. Feel free to ask it again during the break time. Now, does reciprocity service time add to service credit at Acera? It does not. Service credit that you earn in a reciprocal agency, they're going to use that service credit when they do their separate retirement calculation when you go to retire. And your service credit earned under Acera is what we're going to use in our calculation. So we are each going to do a calculation like this. And we're each going to send you a separate check. So the service credit that you earn under each reciprocal agency is used separately by each agency in each calculation. But the salary component is going to be the same. The highest salary will be the same among all of the different reciprocal agencies. And extended sick leave applies to AHS as well. Yeah, it's only AHS people that I think are earning the extended sick leave, and that's what's convertible to service credit. The Alameda Health System people. Okay, so we've talked about the age factor percentage. We've talked about the years of service credit. Let me tell you more about the highest average monthly salary, and this will help you understand how we calculate your retirement allowance. Okay, so when you go to retire, what we need to do is we need to find what your highest average monthly salary is during your career in order to put that in the formula. So what we're going to do is we're going to find your period of highest consecutive pay during your career, and that is what's known as your final compensation period. Okay, now your final compensation period for tiers 1 and 3 is going to be your highest consecutive 26 biweekly or 12 monthly pay periods, depending on how you're paid. For tiers 2 and 4, it's going to be your highest consecutive 78 biweekly or 36 monthly pay periods, depending on how you're paid. So essentially, for tiers 1 and 3, it's your highest consecutive 1 year of pay that we're looking at for your final compensation period. And for tiers 2 and 4, it's your highest consecutive 3 years of pay. Now, our goal for the formula is to figure out what you made on average per month during that time. Okay, so that's a simple calculation. All we do is we take the total amount you made during your final compensation period, your highest year of pay for tiers 1 and 3, and we divide it by the number of months in that period, 12, and that gives us the average that you were making per month during that period. The same for tiers 2 and 4. It's the highest total that you made during 3 years of pay divided by 36 months gives us your highest average monthly salary. So this answers the question that we had early on in the presentation up on the board. Is the highest average monthly salary based on the fiscal or calendar year? It's based on neither. It's based on your pay periods. It's based on your highest consecutive pay periods. So these could fall anytime during the year, and likely they are not going to line up with the fiscal year or the calendar year. And for the vast majority of people, this is going to be your last 3 years of pay or your last year of pay, because for most people, you're getting paid the highest rate at the end of your career. But not always. Sometimes you were getting paid a higher rate earlier in your career, and then we would go find those pay periods. Our database, our software does that for us, and that becomes your final compensation period. Okay, and there's a question. I was on disability for 1 year, but purchased my time back. Does that affect my highest average monthly salary? It does not. If there's a gap, so let's say that your last years, let's say you're in tier 2 and your last 4 years, you were making your highest pay during your career. Okay. So you worked for 1 year and then you went out for a year on disability leave, and then you come back and you work another 2 years. Well, that gap doesn't count against you. If there's a gap, that doesn't change the consecutiveness. So we'll smash those 3 last years together. We'll consider those consecutive. That's one consecutive period, even though there's a gap in time there where you were out on unpaid leave. It doesn't matter. So we'll consider those consecutive pay, and that will be your final compensation period. A slightly different scenario, let's say you work part-time during the time that you're making your highest hourly rate of pay. That doesn't count against you either. Let's say that you're in tier 2 and your last 6 years of work, you're making your highest hourly rate of pay in your career, but you're working half-time. Well, we will take that 6 years of half-time work, smash that all together to get the equivalent of 3 years of full-time work, so that we can do the full calculation based on the 3 years worth of the equivalent of 3 years of full-time pay. Okay, so doing the part-time doesn't count against you either. Okay. Do furlough days affect highest average monthly salary? I'm 99% sure that they do not. And I think that that is usually part of the deal with furlough days, is you don't get the money, but you get the salary credit toward retirement. But to be absolutely certain about that, I would write into us or call into our call center and ask definitively, and they can give you a definitive answer about that. Okay, so more on highest average monthly salary. People ask, what types of pay go into this? Well, if it's paid during your final compensation period, your base pay is, of course, going to go into this. And I'm going to list out 4 types of pay here. We're talking about gross pay for all of these types of pay. Okay, so this is before any deductions are taken out. So your base pay is, of course, going to be considered salary for the purposes of calculating your highest average salary. And I'll use the term synonymously: highest average salary, highest average monthly salary, final average salary. Those are all synonymous for the same highest average monthly salary figure. So your base pay is going to be considered in there. And then there are some other pay codes that could be considered in there. Those are sometimes called footnotes. They're other types of pay based on skills and education. They may be included. And to find out whether they're included, you need to go to this page on our website, sr.org/paycodes. And you pull up the list for your employer and you find your pay code in there, and it'll say yes or no, whether it's in or out. So I can't tell you off the top of my head whether your pay code is included or not, because there's like 1,000 different pay codes. I will tell you that overtime never counts. If you need help finding your pay code on that sheet, ask your payroll manager for more info. Okay, now these last 2 bullet points, I'm just talking to tier 1 and tier 2 people here, because the law prevents tier 4 from including vacation sales and cash out as salary for the highest average salary calculation. That was the new law that the state passed in 2012 that created tier 4. Okay, so sorry, tier 4 people. And for tier 3, for LARPD people, you're not allowed to sell vacation, and that rule prevents us from including any vacation pay in your salary calculation. If that changes in the future, then we would be able to include some of it. Okay, so tier 1 and tier 2 people, I'm talking to you. If you sell vacation while you're still employed, that's vacation sales. And here, let me go to the next slide. And tier 4 members, you can take a snooze, take a break for about 15 minutes, because we're going to take a little bit of a detailed dive into how this vacation pay affects your salary calculation and what vacation pay can be included for the tier 1 and tier 2 people. Okay. So vacation sales, what that means is that you sell your vacation, your earned vacation, back to your employer while you're still employed. Okay. I think there may be an annual opportunity to do that, or you may be able to do it at any time during your employment. You can sell vacation back to your employer and you'll get cash for that. I think you may see it in your next paycheck. You'll get cash for that. And you put that cash in the bank. So that's your cash to keep. Now, the vacation cash out, what that is that means you simply have earned vacation left over in the books when you stop working and or retire. And they will cash you out for that amount at that time. So you'll see an extra amount in your final check, perhaps. I think that's the way it works. So that happens at termination and or retirement. Okay. Now, when we're looking at the amount of vacation pay, this cash that you put in your bank account for the vacation sale that you made during your career and or the vacation cash out that you made at the end of your career that went into your bank account, we're looking at the total compensation between these two amounts. So we're summing these two, and the total vacation compensation is what we are considering on whether we can include it as salary for the purposes of calculating your highest average monthly salary. Okay. And again, this is only vacation sales and cash out made during that final compensation period, that highest period of pay. Now, the cash out, of course, will only be included if your final compensation period is at the end of your career. Okay. So here is how this concept works. If you are paid for your earned vacation that you're not going to take during that final compensation period, okay, that means your total salary during that final compensation period goes up a little bit. The total amount that you got paid during that final compensation period was a little bit bigger. Okay, because your total salary during that time is a little bit bigger, that means your average salary over that final compensation period is a little bit bigger. Because your average salary is also known as your highest average monthly salary, is one of the multipliers in the retirement formula. That means your retirement allowance, as a result of calculating that formula, is going to be a little bit bigger. The bottom line here is that getting paid for your earned vacation during that final compensation period gives you a larger retirement allowance at the time that you retire and for the rest of your life, because we are calculating a little bit extra salary into your salary component of the retirement calculation. Now, how much will it increase your retirement allowance at the time of retirement? This table gives you a very approximate estimate to figure out what the impact of that is going to be, because people, it's a little bit of a sacrifice. It's your earned vacation that you're not going to take. So you're going to get compensated for it. So you don't get to get a much needed break during a time when you may need it. So they always wonder, like, what is the impact of this on my retirement allowance? So this chart kind of gives you an approximation of what the impact of it will be. So most people enter tier 2. I'll start with tier 2. Let's say that you were able to get 6 weeks worth of, okay, and let me step out for a minute here. This impact chart this doesn't apply to Alameda Health System people, because your vacation compensation isn't measured in weeks. And I don't really have a comparable chart for you, but the impact for selling vacation will be kind of comparable. You may get like a 4% to 6% increase. And you can calculate it for yourself, and I'll show you how to do that in just a minute. Okay. So for everyone whose vacation compensation is measured in weeks, if you were able to get compensated for 6 weeks worth of your earned vacation, that would increase your retirement allowance by 3.8% at the time of retirement. Okay, so it's a little bit of a boost to your retirement allowance at the time of retirement. If you were able to go up to 8 weeks worth of compensation, it would be about 5%. If you were able to get as much as 12 weeks, which is pretty rare these days based on the new rules, it would be about 7.7% increase. Okay, so that kind of gives you an approximation. I'm using the word approximate. It's not going to be exact. It's approximate. Okay, for tier 1, those increases are accelerated because the final compensation period is so much shorter. It's only a year. Okay, so you can see that the weeks of compensation have a higher impact on tier 1 benefits. Okay, so, and then there's a question, it only applies if the final comp period is your last one. So what I was saying is that the vacation cash out will only be considered for this as salary toward your salary calculation if your final compensation period is at the end of your career. So that means you're making your highest rate of pay at the end of your career, and that's probably going to mean that your final compensation period is at the end of your career. And in fact, if it's close, if it's a narrow margin, if you do get a cash out, that could change your final compensation period to be the end of your career. So like selling vacation or cashing out vacation increases your salary. So that could shift what your final compensation period is. And our software handles all of this stuff. It says what your absolute highest pay periods are. Okay, good question. Question up on the board. What are the limits? That is a good segue into what the limits are. There's a cap on how much vacation compensation that a SARA can include in your salary. And I use the word must here because the law tells us that we have to include what the amount that up to the cap that we're allowed to include. So if you sell your vacation or your cash out your vacation, and it's the amount up to whatever the cap is, we have to include it in your salary. Okay. So this is all, written in the law. Okay. So this, yeah, anyway, but there's also a cap written in the law. Okay. There's a maximum amount of vacation pay that we can include in the highest average monthly salary calculation. Let me help you find out what that cap is for you, because it's going to be individual to each one of you based on your work situation and how much vacation you earn. Okay. So I'm going to show you two different sections of your retirement planning worksheet. The first one I'm going to do is talk directly to Alameda Health System employees to help you find your cap, because your cap is a lot easier to find. So all you do is you look on your worksheet and you look for this section. And all you need to know is what tier you're in and how many hours of PTO you earn per pay period. Okay, that's probably going to be on your pay stub. And you're going to put that into the worksheet. In this example I'm going to give you, this person earned 6.7692 hours of PTO per pay period. Okay. All you do is, if you're in tier 1, you multiply that by 13, and that gives you your limit in hours. If you're in tier 2, you multiply it by 39, and that gives you your limit in hours. Okay. So in this example, a tier 1 person, we would be allowed to include up to 88 hours worth of vacation compensation through a combination of vacation sales and cash out as salary for the purposes of calculating your retirement. For the tier 2 person, we would be allowed to include up to 264 hours worth of vacation compensation as salary in the salary calculation. The one exception is people who work for AHS in the Uapd union. You have a flat cap. It's 120 hours of PTO for tier 1 and 360 hours of PTO for tier 2. Okay. So you don't need to do a calculation. It's the same for everyone. Okay, so AHS people, go ahead and do the calculation if you happen to know your hours of pay time off, and now you know what your limitation is, your cap. Okay, now everyone else. So county and people who work for the other employers. What you're going to need to know is two numbers. You're going to need to know how much vacation you earn per week. I'm sorry, how many weeks of vacation you earn per year. Okay. And you earn 2 weeks vacation per year, or 3 weeks per year, or 4 weeks per year. And it's dependent on how long you've been, what's that word? It's not longevity. It's the other word, seniority. It's dependent on how long you've been working for your employer. And so you're going to put that number into the table here. Okay, so in this example, this person earns 5 weeks of vacation per year. Now, you're also going to need to know how many weeks of vacation your employer allows you to sell per year. That's also known as payable. Okay, so there's some rule in your employer's rule book. will allow you to sell 2 weeks of vacation per year, or 3 weeks of vacation per year, or some amount of weeks of your earned vacation per year. And that's the maximum that you can sell per year. You need to know what that number is, and you put that in the table. If you don't know what it is, your payroll clerk will know what that is. Okay. For tier 1 members, you only need to fill out the first 2 boxes, the first column. For tier 2 members, you're going to need to fill out all 3 columns because we need to do each of the 3 years of your final compensation period separately. Okay, in this example, the amounts didn't change. They earned 5 weeks of vacation each one of the 3 years of the final compensation period, and they were allowed to sell vacation for each one of those 3 years. Okay, now the worksheet is telling you that you need to get your limit from the calculator. Okay, the calculator is out on our website, and the worksheet tells you what the address is. It's acera.org/vacation. Okay, and this is what the calculator looks like. I'll actually switch over to the website and I'll show it to you. So we're going to go to acera.org/vacation. Okay, now this is the section where it kind of describes what I'm describing to you right now about how unused vacation affects your retirement allowance. So you're going to scroll down here. You're going to open up this accordion for Alameda County Courts and Housing Authority. And you're going to use one of these calculators. If you're in tier 1, you're going to put in the number of weeks of vacation you earn in the first field, and then you're going to use the drop down to pick the number of weeks you earn, you're allowed to sell in the second field. And this tells you what your cap is. In this case, it's 2 weeks. Okay. For tier 2, you need to do that for each one of the 3 1-year periods. So I'll stick with that example. It was 5 weeks of vacation earned per year, and you're allowed to sell 2. 5 weeks of vacation earned per year, and you're allowed to sell 2. 5 weeks of vacation earned per year, and you're allowed to sell 2. And then it gives you a running total as you enter those. All it's doing is it's taking the lesser number of each one of these 1-year periods, and then it's summing them up. So the lesser number in each case is 2. 2 plus 2 plus 2 is 6. That's how it gets the limit. And that's why the limit for tier 1 is 2, because it's the lesser of the 2 numbers. Okay, so now that you know your limit, you go back to your worksheet and you put in that limit in the limit field in the worksheet. Okay, so now we have that solved. We know what your limit is. Okay, now I'll help you figure out what to do regarding selling vacation or cashing it out. One option that you have, if you are interested in this topic at all, and you are thinking, I might want to think about selling vacation or cashing it out because I'm interested in this way that it increases my retirement allowance. So how could I go about that? Probably the easiest way to go about it in most cases is to simply take your limit and just have that amount of vacation on the books when you retire. Okay. So in this case, their limit is 6. They simply have 6 weeks of vacation on the books when they retire. Don't worry about selling any. Sell 0, okay, in order to get up to the 6. Now, let me give you a slightly different example where you might actually want to sell some vacation. If you have a different limit that's a little bit higher and your weeks of vacation that you earn is a little bit lower, that might put you in a scenario where you might want to sell vacation. So in this scenario I'm giving you, this person is in tier 2. They only earn 4 weeks of vacation per year, and they're allowed to sell 3 weeks of those vacation if they want to, those vacation weeks. So your employer, so if we go to the calculator, their limit is going to be 9 weeks of vacation because it's the lesser of each one of these 1-year periods. 3 plus 3 plus 3 is 9. Now, your employer has an additional limitation for you. They will only cash you out in all cases, I think I'm talking to everyone except for Alameda Health System. They will only cash you out for 2 times your accrual rate. Okay. I think for Alameda Health System people, they will cash you out for your entire PTO that you have left on the books. So you may want to double check that I'm correct about that with your employer, but I think that's the case. But for everyone else, they'll only cash you out for 2 times your accrual rate. So in this example, this person accrues vacation at a rate of 4 weeks per year. 2 times 4 is 8. They can only have up to 8 weeks of vacation on the books and get cashed out. Okay. If they have 9 weeks of vacation on the books, um, that extra week of vacation is going to go poof. It's going to disappear. They're not going to get any cash for it. They didn't take the 1 week extra week of vacation. It's just going to disappear. Okay. They will only cash you out for 2 times your accrual rate. So that is the case. You may need to sell if you can't get up to the limit simply through the cash out. Okay. So this person is going to cash out their maximum of 8 weeks that they're allowed to cash out from their employer. That doesn't get them up to the 9. So that in that case, they may want to actually sell a week while they're still employed. And that is the reason that you may want to sell vacation. Okay. Otherwise, if you're in the previous scenario and your 2 times your accrual rate is way more than whatever your limit is, don't even worry about it. Just, cash out what the limit is. Now, some of you may be asking, well, I already sold vacation. What do I do if I already sold a bunch of vacation? Okay. So you have 2 different options. Let's say that, sticking with this example, your limit from the calculator is 9 weeks of vacation pay we're allowed to include in the salary calculation, and you've already sold 5 weeks of vacation at some point, like in the 3 years leading up to retirement. Let's say that your final compensation period is going to be your last 3 years. Okay, how much should you cash out to get up to the 9? Well, your option number 1, of course, is to cash out the difference. Just take the 5 you've already sold, and then cash out the remainder, the 4, to get up to the 9. Option number 2 is if you want to, if it's, financially something that works for you and you just happen to have more vacation on the books and you want to cash it out more, you can go ahead and do that. You can cash out up to 2 times your accrual rate, up to 8, and you would get a total of 13 weeks of vacation pay in your bank account from between the 5 that you sold back to your employer. That money goes into your bank account. The 8 that you're cashing out, that goes into your bank account. But state law tells us that we must limit the amount of salary we're allowed to include, the vacation pay we're allowed to include in the salary calculation, 9 weeks. So we will only put 9 weeks worth of that pay as salary into your salary calculation, but that 4 extra still went into your bank account. Okay. Okay, here's a question. I bought vacation and it's still on the books. What will happen to it? Well, I think the purchased vacation, I'm not sure if purchased vacation is use it or lose it by the time that you stop working, but purchasing vacation is actually a good thing to have at this point, because that means that you have an additional week of vacation that you purchase that you can use to take a vacation when you need it, and then retain your earned vacation in order to get cashed out for it in order to increase your retirement allowance. So that's a good position to be in, because the purchase vacation, yes, you go out on the purchase vacation and you don't get service credit for it. But like I said, you go out on a 2-week purchase vacation, you're going to have 2 weeks less of service credit. It's not a big deal versus having 2 weeks of earned vacation. 2 weeks worth of earned vacation is going to boost your, let me go back here. If you're in tier 2, it's going to boost your retirement allowance by 1.3%, which is huge. Okay. So the power of this earned vacation included as salary is pretty powerful, which is a really awkward way to the discussion is getting long. I'm losing my words, but it's a pretty powerful way to increase your retirement allowance. Okay, so let's see. I see some questions forming, and then I'll answer the questions and then we'll take a break. So if I can cash out 6 weeks, I only need 6 weeks on the books. I thought to get the vacation count in the final compensation, I need the max of 5 weeks on the books plus the 6 weeks. Do I need 11 weeks or will I lose the 5 weeks? Okay. Yeah, this stuff can get confusing, and we try to make it as simple as possible, but the law is like, it's convoluted, and it's like there was an initial law and then there was like a court decision that changed how this was calculated, and then another law and then another decision, and so it's like building on top of each other, which makes it to the point where it's gotten kind of complicated. So let me go back, since you're talking about a limit of 6 weeks, I'll stick with this example. So it sounds like your limit is that you're allowed. Are you saying that your limit is going to, from the calculator, is going to be 6 weeks worth of vacation pay that we're allowed to include in the calculation for you? So you can go ahead and, okay, great. So your limit is 6 weeks. In no scenario between selling and cashing out are we going to be allowed to include more than 6 weeks worth of vacation pay as salary for the purposes of calculating your salary component of your retirement allowance. So it doesn't matter what combination of sales and cash out you do. And it doesn't matter if between selling and cashing out, you get paid for more than 6 weeks, like you're talking about 11 weeks here, that you'll still get, if you do between selling and cashing out, get paid for 11 weeks worth of vacation pay. 6 is the absolute maximum number of weeks worth of pay we can include in the salary calculation for you. Okay. So you can figure out what's best for you to do based on that. My guess would be just simply have 6 weeks of vacation on the books when you cash out. And then for that extra 5 weeks, it sounds like you may have hanging around, you can either take that vacation to get another 5 weeks of service credit. You could sell it to get cash for it. You could, if it doesn't between, if you don't go over more than 2 times your accrual rate with the 5 and the 6 that you have on the books, you could cash it out. So yeah, it's up to you, but just whatever you do, don't lose it. Don't have more than 2 times your accrual rate on the books when you go to stop working. Okay, next question. Can Alameda Health System Uapd members buy vacation hours if needed? Are you talking about making a vacation purchase to purchase additional vacation on top of your PTO that you earn? If that's the question, I don't know the answer to that. That would be something that you would want to check with your payroll clerk about. Okay, so you're saying you need time off, but you're out of PTO. So yeah, that would be something to inquire to your employer about whether you can purchase additional vacation to be able to get more of that time off. Sure. Yeah. And yeah, I mean, if you really need time off, I mean, there may be the opportunity to go on unpaid leave. And just because you're on unpaid leave, as long as you still have your employment, you're still a member of Acera. You're just kind of, in unpaid leave status. Or maybe you have some. Oh yeah, if you're in AHS and you have PTO, you don't have sick leave either. Yeah. Okay. Let's see. There's one more question up here. Does the retirement benefit estimate calculator automatically take into account the maximums? Okay, good question. It does not. These limits are not programmed into it, but I can help you understand how to do the estimator without overestimating. Okay, so let's welcome back our Tier 4 members and move on to, let's hang on to that question until I'll go through the benefit estimator, and I'll show you how to do the estimate without estimating. Okay, I'm sorry, I'll show you how to do the benefit estimate without overestimating on the vacation hours. Okay, so hang on to that question. Okay, let's talk about limits on your monthly payments. So there are some limits to what your retirement allowance can be. The first is that your highest average monthly salary, your retirement allowance cannot be more than 100% of whatever we calculate your highest average monthly salary to be. The idea here is that you're not making more in retirement than you were making when you were working. Now that's mostly true, but if you recall from the discussion that we were just having, your highest average salary can actually be a slight bit higher, highest average monthly salary, because of that vacation compensation. But essentially, that principle holds true. And so that is not something that a cap that most people hit, because you have to work, 35 years in tier 1, maybe over 40 years in tier 2 and be a certain age. So most of our retirees retire with 20 years of service credit on average. So most people do not have to worry about hitting that cap. For these next two, those are for people who have large salaries. And so I'll just let you read that information on your own, because that doesn't apply to most people. You may want to go to our webpage, acera.org/limits, to read more about those two, if that does apply to you. For the tier 4 people, we have to cap your salary at an annual limit of what we are allowed to include for the purposes of calculating your retirement. It looks like I did not update this slide. Sorry about that. The limits are actually higher for 2022. The limits go up every year. So for the 2022 caps for tier 4 general members is $134,974 annual dollars. And for the safety members in tier 4, it's $161,969 currently. That means that if you have more salary than that, when we go to calculate your retirement, we can't include more annual salary than that in terms of the total pay that we're looking at when we calculate your retirement. So that's the bad news. The good news is that we monitor this as you're getting paid throughout the year. And whenever you go over that amount in the year, say you're a tier 4 general member and you earn 134,000 plus in November, after that, we stop taking retirement contributions out of your check. And that gives you a lot more money to save in your 457B account, if you open a 457B account, or in your personal savings and investments. Okay, let's talk about estimating your retirement allowance. I showed you how we calculate your retirement allowance in general. Let's talk specifically about you. How do you get an individual estimate of what you are going to receive as your monthly lifetime retirement allowance? So I'm going to show you two ways, and these are both on your retirement planning worksheet. The first one I'm going to show you, and you're going to want to look under the estimating my retirement heading. I'm going to show you how to get a ballpark estimate. Okay. So all you're going to do is you're going to think of your retirement scenario in general. How old are you going to be when you retire? Okay. So you think about that. In this example, I'll say 58. And then you think about how many years of service credit you will have in this retirement scenario where you're retiring at age 58. And in this example, I'm going to use 29 years of service credit. Okay. You're going to go use one of our salary replacement charts on our website, and you can find those at acera.org/ballpark, or I'll show you how to navigate those on the site. So from our home page, you can go down to members, and you're going to go under members up here, and you're going to go down to planning your future retirement income. Okay, under the menu. And you go down to the first step, getting an Acera estimate. The very first option is describing what I'm telling you how to do, getting a quick ballpark estimate. And you're going to click on you're going to click on the button for your tier. So I think this is a tier 2 example. Yeah. Okay, so in that example I was giving you, in my retirement scenario, I'm retiring at age 58. So you can see the ages are across the x-axis. And then the years of service credit are down the y-axis. And then you just find where they intersect. So 29 years of service credit, age 58. That means that I'm going to get 50.03% of my working salary as my lifetime retirement allowance, plus cost of living increases. Okay. Now, these charts are interesting because once you find where your scenario intersects, you can go down diagonally. You can proceed diagonally to see what the effect of working another year is, because you're going to get another year older. So you're going to move over one column and you're going to have another year of service credit if you're working full time. So you move one column down. And by working another year, I would get 54.5% of my salary. By working another year, after that, I would get 59.42% of my salary. And that's because the age percentages are going up and the years of service credit are going up. And that's why we have this chart where they intersect. And we've already multiplied it out for you. Okay, but in that example, I was saying that I was going to get 50% of my salary, essentially. So what I'll do is I'll come back over here and I can just put in 50. And then I can just kind of think, since this is kind of a quick ballpark estimate, you can just kind of think about what you get paid every month. So you can kind of, write it out on a scratch piece of paper. Let's say it was $6,000. Since my retirement allowance is going to be half of that, it's going to be 50%. 50.03% times 6,000, it's about $3,000. That's how to get a quick ballpark estimate. Now let me show you how to get a precision estimate with our online benefit estimator. This is another spot on your retirement planning worksheet. So again, you're thinking of a retirement scenario. In this one, you're going to get more specific. What is my separation date and what is my projected retirement date? Your separation date is your last day on payroll. Your projected retirement date is your first day of retirement. If you are going straight into retirement, these will be on consecutive days. Okay. Then you're going to go out to our website. You click the login button and you log into your account. If you've never done that before, you can create a login for yourself. And once you get in there, you'll find that your pension data is waiting there for you. The first thing you're going to see is this account summary screen that has a lot of pension information about your membership, and you're going to click on Estimate a Benefit. On the benefit estimator, this top portion is where you put in your separation date and projected retirement date. So I'm just going to zoom in, and in this scenario, I'm putting in 2 consecutive dates in 2030, and I'm going to hit Calculate. Okay. And if you're planning on becoming a deferred member, so like you're going to stop work and then retire later, there would be a big gap between these dates, and that's fine to do. The calculator can handle that. Okay. So once you put in your dates, you hit Calculate, it will give you a projection of your service credit that you will have earned in this retirement scenario. Okay. It will also give you a salary projection based on your current highest salary. You can override both of those numbers if you like. You may want to override service credit if you happen to know you're going to make a service credit purchase and you want to see the impact of that on your retirement allowance. And if that was the case, what you would do is take the amount that you're going to purchase, add it to this number, and put the new total in this blank. And then you can override the salary if you want. If you know you're going to get a raise and you're not going to retire for 3 years and you want to see how that raise would affect your salary, you can put that higher salary in here. Okay. And then we're going to leave this blank for now. This is where you're going to add hours of cash vacation compensation if you want to get an estimate of that. And then you can put in beneficiary information in here and then click get an estimate. And then you end up with this ACERA benefit estimate. This information up here is where you are, it's telling you about your membership and about the numbers it's using to calculate the estimate. And then this down here is your retirement allowance estimate under the different options. Let me check this question on the board real fast. So there's a question, is the maximum increased to allow for COLA? I don't remember what topic we were on when you asked that question. Nothing about our calculation our retirement calculation is increased to figure for a future COLA payment. So whatever we're calculating is based on past experience. If that's the question you're asking. Let me know if that's not the question you're asking. Okay, so what I'm going to show you now, okay, your max retirement compensation. And the question was, is the maximum retirement compensation increased to allow for cost of living adjustments? Only like if you're talking about working cost of living adjustments that you're getting from your employer while you're still working, I mean, that's part of your salary. So yeah, that will show up. Increases in salary show up as increases in retirement allowance when we do the calculation. If you're asking that when you go to retire, when we're doing our calculation, are we figuring like a future COLA payment to your retirement allowance in that calculation? We are not. We only start paying cost of living adjustments once you're retired. So that's okay. And your question is, can my retirement pay exceed my salary as a result of COLA? I see. So you're talking about that 100%. Okay, I see what you're saying. That 100% limit is only at the time of retirement. So after retirement, absolutely. Absolutely. Thanks for clarifying that question. Sorry, I wasn't understanding. Yeah, after retirement, you're going to get cost of living adjustments, and it doesn't matter whatever the calculation was. If you hit the 100%, that's fine. After that, you're going to get cost of living increases. Yeah. Okay, so now let me show you how you can estimate, how you can use this field here, the hours of cash vacation compensation, without overestimating, in order to see what the effect, you can allow the benefit estimator to see what the effect of having additional hours of cash vacation compensation in your salary will be on your retirement allowance and dollar-wise. So this is kind of a more precise method. I was showing you before the chart that had the percentage increases. This is how you can see the dollar impact on your retirement allowance. So what I'm attempting to do here, the reason that I have this extra little part of the worksheet here is because I don't want you to overestimate. I don't want you to put in more hours than your limit in this field. And one of the ways that can happen is because if you already sold vacation during the pay periods that the system is using to make your salary projection, it's already figuring that vacation sale in here. And we want to subtract that out before you put in hours into the calculator. So step one is to run an estimate and leave the hours of cash vacation compensation field blank. Okay. And then you're going to want to look at the average salary date range on the estimate. And you're going to want to go ahead and put in your limit for the people in the county and the other employers. You put in your limit in weeks here because we need to convert it to hours. And then you're going to want to put in your weekly work hours here and multiply them together to get your limit in hours. For the AHS members, we already know your limit in hours, and so you can just start here. Okay, so now we have your limit in hours. So now what we're going to do is we're going to take that retirement estimate that we ran where we left the hours of cash vacation compensation field blank, and we're going to look at the salary date range that it's using. These are the salary dates, the pay dates that it's using to the pay period dates that it's using to do the salary calculation. And you think, during this pay range, did I sell any vacation? If so, how much vacation did I sell? Okay, so you're going to have to think back to what you did. Maybe you need to pull up some old pay stubs. And you're going to put, if that amount is 0, that's great. You can just put in 0 here. But if you did sell some vacation during that time, you're going to want to subtract that out from your limit. So you put that in here. Let's say that I sold a week of vacation during that range. So I'm going to go ahead and subtract that amount out from my limit. And this, if I want to see what my full limit of hours of cash vacation compensation would be for the benefit estimator, that's the number I would put in here. Now, if I didn't sell any vacation during that, then I would put in the 240 in that scenario. But use your own numbers because all of your numbers are going to be different. And then you hit get estimate, and then it will show up. It will tell you how many hours of cash vacation compensation it's including on top of the vacation sales in here. And just to zoom in, this is your benefit estimate for the different options. And I'll talk about the different options a little bit later. For right now, you can just look at the unmodified option. This is the one that most people pick because it's the highest retirement allowance of any of the other options. And if you want to, you can go ahead and put that number into the precision estimate field on the worksheet. So you can kind of keep track of what you did in that estimate, or you could just print out that PDF, because this is a PDF that you save on your computer. You could just print it out and staple it to the sheet, or just save it in the same folder on your computer. Okay, let me see. There's a question here. Sorry, the beneficiary allowance also gets cost of living adjustments. Yes. Yep. So this is showing what your beneficiaries would get in their continuance. They also get cost of living increases. So yes. And I'll take a deeper dive into the options and the beneficiaries when I talk about the options. So I showed you how to get a ballpark estimate. I showed you how to get a precision estimate. If you're not interested in either one of those, or you've already tried them and you're still, you would rather have somebody from Acera calculate it for you, you can fill out a retirement estimate request form on our forms page and send it in to us. There is a wait time for that because we get a lot of those requests. It does use the same software and the same math as Web Member Services, which is our member portal that you're using. So you're going to get the same results either way. And the benefit estimator I just showed you is available 24/7. So you can use that. You can make as many of those estimates as you want. You can use it all the time. Okay. So that was a big topic, helping you get an estimate of your future retirement. Okay, so we're done with that. Now I'm going to help you verify your retirement eligibility. Okay, there's a question, how accurate is the estimator? It's very accurate. There could be a lag time of 2 to 4 weeks where your last pay period or 2 pay periods of salary have not been uploaded. And so that salary projection that it's doing is giving you a kind of a little bit older projection. So it could be a little bit, there could be some lag time in there, but it's very accurate. The only time that it would not be accurate is if you had some kind of, what do they call that? Payroll adjustment. If you had some kind of payroll adjustment where you got a bunch of pay like all at one time in one paycheck, and that was your last paycheck that's on file in there. And what it does is if it needs to project pay periods in the future to fill out empty pay periods from the future that it doesn't have yet, it will take your last pay period and fill in the rest of them. And so if you do have like a payroll adjustment in one of those in the last pay period, it might be overestimating your pay for a couple of weeks. So if you go in here and your average monthly salary seems way too high, that, go look at your payroll records and that might be happening. Otherwise, it's very accurate. Okay. Would it know that I'm working part-time in the last few years? Yes. So it will automatically calculate your highest pay periods, even if you're part-time. Okay. So the next topic we're on is verifying your retirement eligibility. And if you remember back to our pension milestone timeline, that's this milestone here. This is the date that you become eligible to first retire. And like I said, you can retire on this day, or you can keep working and earning more credit toward retirement and then choose some other day in the future. You're choosing your retirement date. So when you become eligible to retire is when you meet for tiers 1, 2, and 3, one of these 3 sets of criteria. And I'll show you tier 4 in just a minute. So option 1 to become eligible to retire is that you're over age 50, you have at least 5 years of service credit, and you have at least 10 years of membership. Okay, you're age 50 or older. Now, if you are working straight into retirement, what you can kind of think about this as is you have at least 10 years of service credit and you're over age 50, because you will meet both requirements in that case. But if you're not going to, you really only need to work 5 years, and then you can stop working, but you can't retire yet. You would have to wait until you have 10 total years of membership. So you'd be waiting as a deferred member, where you've stopped working, but you've deferred your retirement to a later date until that 10 years passes. And then as long as you're over age 50, then you can retire out of deferred status. Okay, option number 2 is that as a general member, you can have 30 years of service credit, or as a safety member, you can have 20 years of service credit and retire at any age. Option number 3 is that you can have any amount of service credit and retire at age 70, even if it's less than the 5 years that you need for option 1. Okay. And there's a question on option 1. Excuse me. Okay, this is a question about the different retirement options. I'll save that question for when I get to those options. The short answer is yes, though. Yeah. Oh, the monthly annuity payment? No. Just going back real fast. On option 1, this is your retirement allowance estimate, not this one. Okay. And I'll explain those in a little bit. Okay, so that's how you become eligible to retire under tiers 1, 2, and 3. For tier 4, you have 2 different scenarios for retirement eligibility. You're a general member and you're at least age 52, or you're a safety member and you're at least age 50 and you have at least 5 years of service credit and you can retire. Or you can retire at age 70 with any amount of service credit, even if it's less than the 5 years you need under option 1. Okay, it's pretty simple to become eligible to retire. So now that you know what it takes to become eligible to retire, you can kind of think of what your retirement eligibility date might be, and you can write it in here if you like. If you already happen to know you're eligible to retire because that happened long ago, you don't even worry about calculating it. You can write an approximation in here. Okay. Now, the next topic on our checklist is choosing your retirement date. So this is the next milestone on our pension milestone chart, the date that you choose for retirement. So I'm going to take you through these 6 different things to think about regarding finding the best day to retire. And I'll do each one individually. Okay. First of all, will you have enough income to retire? This is something that a lot of people will want to think about when planning for retirement. Leading up to retirement, it's nice to do a little projection and see what your income is going to be after retirement, because you know what your income is before retirement, and you know how well you are able to pay for your life before retirement. So it's good to see what your income is going to be after retirement. And you do that by simply getting that ACERA retirement estimate like we were just talking about. And also, it's a good idea to contact the deferred compensation program, see how much money is in there, see how much money they advise you on withdrawing from your account at certain ages. And so they can help you through that. And in fact, Gene Hilliard from the county's deferred compensation program is going to be here for our post session at noon, and he's going to tell you all about that. And he will even tell you if you don't have a deferred compensation account yet, and you're wondering if it's too late, it's not. You can do catch-up payments toward the end of your career to save additional money right before retirement. And then it's also good to get an estimate from Social Security if you have been paying into the Social Security system for at least 10 full-time years. Then you will be able to collect Social Security. And so you can get an estimate from Social Security just by going to their estimator, online estimator. It's just about as simple as ours is. It's super quick to get an estimate. If you've never done it, I highly recommend it. And then this is kind of extra credit if you want to. You can think about your post-retirement expenses, and you could even do a spreadsheet or just do a simple math problem to see what your income is going to be, add up all your income after retirement and then think about whether that's enough to pay for your post-retirement expenses. So you don't have to do that. Another way that people will do this without thinking about, digging into the details of post-retirement expenses is just simply by aiming at this number. Financial advisors would tell you that you need 70 to 80% of your pre-retirement income in retirement to maintain your standard of living. So whatever you're making now, you're going to need just 70 to 80% of that in retirement to maintain your standard of living. And so if you do an estimate and add up the first three, you can kind of see like how that compares with what you're currently making. I think that if you really want to dig into this topic further about kind of doing income projections, what I recommend is you go out to our homepage. You scroll down to this berry colored section, ready to retire. This has a bunch of links for you on getting ready to retire. And what you can do is click on the prepare to retire section. This is the chronological section that we want you to go through in preparation for retirement. So there's about, let me see, 12, what do we got here? 9, 10, 11 topics here. One of those, if you want to, is estimating your retirement income. And so this kind of takes you step by step in doing that if you want to. And it has links out to the estimators. There's a link to the Prudential login if you have a 457B account. You can even do this AARP retirement calculator that we've linked you to calculate whether you'll have enough income. And then there's even a budget worksheet, which is kind of the extra credit portion that I was talking about. So that's up to you. Okay, let me check the questions here. Okay, so you're saying you're confused. You're tier 2, you're age 62, and you have 18 years of service. You can retire, right? So you're tier 2, you're age 62, so you're over age 50. You have 18 years of service, so you definitely have at least 5 years of credit and at least 10 years of membership. So yes, you are eligible to retire. Yeah, you don't need 20 years. 20 years is a number that some people get in their head because I guess the average person retires with 20 years. But yeah, you only need 5 years of service credit and a total of 10 years of membership at the minimum for those tiers. In tier 4, you only need the 5 years and without the membership thing. Okay, and then there's a question, how do we know if a SARA has the required documents like the birth certificate? Yeah, if you don't remember whether you've provided that to us or not, you can simply write into our call center and ask, and we'll tell you whether you need to send those in or not. And we do have an upload feature in your member account where you can upload documents securely like that. Okay, so item number 2, in terms of choosing your retirement date, this is something that I want you to think about. This is the age factor percentage dates. And this is something that you only need to think about if you're still younger than the maximum age factor percentage for your tier. So if you recall, tier 1 was age 62, tier 1 general, age 62, tier 2 general, age 65, tier 3, I think is 55, tier 4 is 67. Safety, tiers 1 and tier 2B are 50. I don't remember the other ones off the top of my head. But if you're older than those ages, you've already reached the age factor percentage, maximum age factor percentage, and you don't need to think about this. Otherwise, I want you to just be cognizant of what these dates are. Let me give you an example. Let's say that you are young enough where you have not yet reached the maximum age factor percentage for your tier. And let's say your birthday is January 15th. Okay, that means that if you work past your birthday, so you work on January 15th, or take a vacation day that day, or a purchased vacation day that day. But as long as you're on payroll that day, and then you pass to the next day, January 16th, then you pass that marker, okay? And you go up one notch in the age factor chart. 1 quarter after your birthday is April 15th. 2 quarters after your birthday is July 15th. 3 quarters after your birthday is October 15th. Every time you pass one of these dates, you have an incremental increase in that age factor percentage, and you get a slightly higher age factor percentage in the formula for you, which equals a higher retirement allowance. Okay. Now, let's say that this is my scenario, and I'm thinking about retiring on July 14th. Well, you can see that I don't want to do that, okay? What I want to do is I want to work on July 15th, retire on July 16th, and that means I will pass that age factor percentage day, and that will increase my retirement allowance by a little over 1% just by waiting 2 days, okay? So, and the same goes with all of the other dates. So what I'm trying to tell you is that don't retire if you're younger than the maximum age factor percentage, just know what these dates are and don't retire right before one. Okay. Just know what they are, work another week or a few days or whatever you have to get over the hump and get that next highest age factor percentage. Now, if you're going to retire like halfway between these 2 days, because these are all 3 months apart, so it's like, 6 weeks after the last date, and it's not going to be another 6 weeks into the next one, that's fine. You don't have to work an additional 6 weeks and retire right after the next one. It's just, I'm trying to make it so that you know what these dates are for you and you don't miss out on a little bit of money by retiring right before one of the dates. Okay, next topic in choosing your retirement date, the cost of living adjustment. This is paid to all retirees annually on April 1st. So if on your first year of retirement, if your date of retirement is on April 1st or before April 1st, you will get the cost of living increase for that year. If it's on April 2nd or after, you won't get a cost of living increase until the following April 1st rolls around. And the cost of living increase, also called the cost of living adjustment, is calculated annually based on the percentage of inflation based on the consumer price index in the San Francisco Bay Area. So if prices from December to December in the Bay go up 5%, that becomes the cost of living adjustment we're looking at, except for there's a maximum annual limit on your cost of living adjustment. For tiers 1 and 3, it's 3%. For tiers 2 and 4, it's 2%. Okay. So that's the maximum cost of living adjustment you can get in any 1 year. So then if inflation is more than that, what happens, like the 5% example I was giving you, what happens to the extra percentage points? They roll over into a COLA bank that we have for you, or we save extra percentage points for you for years in the future. Maybe inflation is 1% the next year. So we'll take percentage points out of your COLA bank to get you up to the max. The bottom line here is that if you've been retired for at least a few years, almost everyone has percentage points in their COLA bank. And then you just tend to get paid the maximum cost of living adjustment every year. So that's something that you can come to expect after a few years of inflation. Okay, let's see. There's a question. On what percentage factor chart for tier 2? Okay, I see. I see what the question is. You're asking about the age factor percentages versus those percentages I showed you on the income replacement chart. Let me go back to that real fast. Okay, so we were on tier 2. You were talking about 39 years. And then, did I hit the right one? Age 65. Looks like it's, I'm not sure where the 92.41% is that you're looking at. Maybe you're looking at 38 years. But anyway, where do these percentages come from? What we've done is we've taken the age factor percentage for that whole age, and we've already multiplied it by the years of service credit for you. And this is your amount of income replacement. So in your example, you're saying 92.41%, that's going to be your amount of income replacement. So you have way definitely gotten the over 80% income replacement that financial advisors suggest. So you're in good shape. But that's where the numbers come from. Okay, so back to the cost of living adjustment discussion. Okay, so then there is a question. So you do not retire before April 1st. A lot of people actually retire on or before, right before April 1st, because they're already going to retire in the spring and they want to get that instant cost of living increase. So let's say that you retire on April 1st and the cost of living adjustment is going to be the maximum. And I actually, we heard yesterday in our board meeting or our retirees committee meeting for the Board of Retirement what the COLA is going to be for this year. And the CPI number is 4%. So everyone, including new retirees, are going to get the maximum. Okay. So all you would do is you would retire on or before April 1st, and we would calculate your retirement allowance, and then we would automatically increase it by the 2% or the 3%, depending on your tier. And that would become your beginning retirement allowance. So that's how that would happen. If you retired on April 2nd, you would miss out on this year's cost of living adjustment. But next year, when April 1st comes around, you would get next year's cost of living increase. And then the following year, when that comes around, you would get that increase, and so on and so forth. Okay. And yes, that is why a lot of people retire around March, because you're already thinking about retiring in the spring and you're like, okay, should I retire in March or April? Well, March, of course, because I'm going to get an immediate increase to my retirement allowance. And if I retire in April, I'm going to miss out on the increase I could have just had. And so I'll actually make less by retiring in April. But that actually quickly resolves itself through the year, maybe after 2 to 3 months, where after 2 to 3 months, you'll make more service credit. Your service credit will increase to the point that will beat the cost of living adjustment that you could have had in April. And also you will probably, if this applies to you, you'll pass more age factor percentage days. As soon as you work for 3 months and pass 2 age factor percentage days, or maybe even 1 age factor percentage day, then that will beat the cost of living adjustment. Okay. So there's a question. I heard that the 2% is calculated each year on your original retirement compensation, so not on the accrued cost of living each year. Is that true? That is not true. The cost of living increase is calculated, is compounded. So it's calculated on the new amount each year. Okay, so next thing I want to show you is sometimes there's a dilemma between the age factor percentage versus the cost of living adjustment for people that are gonna retire in the springtime. Okay, this may not apply to a lot of people, but it does often apply to some people. So I like to just point this out. Let's stick with the January 15th birthday example. And this is a member who is still younger than the maximum age factor percentage, and they're retiring in the spring. Okay. Let's say it's me. Let's say I'm going to do that. So I know I'm going to retire in the spring. Should I retire on April 16th, which means that I worked on April 15th, which is 1 quarter after my birthday. And that means that I'm going to get the age factor increase for retiring 1 quarter after my birthday from that date that I just passed, April 15th, but I'm going to miss out on the cost of living increase that I would have gotten had I retired a few weeks ago on April 1st or before. Or should I retire on or before April 1st and I would miss out on the age factor increase that I'm going to get in a couple of weeks, but I would get the cost of living increase? Well, you probably already know the answer to this because I already told you the percentages. But if the cost of living increase is going to be the maximum for that year, and we always know in early February what it's going to be, I just told you it's the maximum, the 2 or 3%, then you go with the cost of living increase because it's going to be a 2 or 3% increase versus the 1% and change increase that you would get for the single age factor increase. Now, like I said, you do you work past April 16th, you work past July 16th, you get 2 age factor increases plus 3 months of service credit. That's going to beat the 2 or 3% cost of living increase. And you can do all this for yourself if you do the benefit estimator and you do the different retirement scenarios. And so you run one benefit estimate for on or before April 1st, and then you increase it you multiply it by 0.012 to get to for 2% or 0.013 per 3%. That would show you what your new retirement allowance would be with the cost of living increase. And then you can compare that to any other future retirement estimates you run in the benefit estimator for retiring after April 1st. Okay, next topic for choosing your retirement date. Oh, you're questioning the July 16th. Well, the July 16th is 2 quarters after the birthday in this example. Now, just to be clear, you got to think about your birthday. If your birthday is not January 15th, then you're going to have a different set of quarter year age factor days. So if your birthday is January 5th, then 1 quarter after your birthday is April 5th, 2 quarters is July 5th, 3 quarters is October 5th, and then back to your birthday. So that's what the age factor percentage day cutoffs are all about. Okay. If your plan is to get that if your plan is for us to do the service, let me start over one more time. If your plan is for us to do the sick leave conversion for you to service credit, because you're going to have sick leave left over in the books when you retire, and you want us to convert that to service credit for you automatically, which we will do, you need to make sure that you are going straight into retirement. Okay, so this applies only to the people who are trying to go straight into retirement. Anyone who's retiring out of deferred status, you don't have to worry about this, because if you spend even 1 day as a deferred member, you just lose all your sick leave. That's just the way your employer has it set up. So sorry about that. But what I'm trying to illustrate here is if you're trying to go straight into retirement, I'm trying to help you do it without spending even 1 day in deferred status so we can do the sick leave conversion. So what you're going to want to do is retire on the day after your last day of work. So your first day of retirement is the next day after your last day of work. Another way to say it is your last day of work is before the date of your that you write on your retirement application. So this is the date, your last day of work, your last day on payroll, your last day in active employment status. These are all synonyms. This is the date that you write on your letter of resignation to your employer. It's your last day on payroll. Retirement date, that's the date that you write on your retirement application to Acera. That means that these are 2 consecutive days and you're going straight into retirement. Okay, and we will convert your sick leave to service credit. Okay, now on a related topic, you're also going to want to make sure that you're retiring on a non-holiday day where you're scheduled to work the day before. And I think they also want the last day of work to be a non-holiday day. You can check with our staff on that about that, but if you're retiring, just to make it easy, don't have your last day of work or your first day of retirement be on a holiday. I think it's the last day of work though. And you also want to make sure that you are scheduled to work the day before. So it's a day that you're either regularly scheduled to work or that when it comes down to that time, you are scheduled to work. It's okay to be on leave that day. So the example I'm giving is if you work Monday to Friday, you don't retire on Sunday or Monday because you're not scheduled normally to work on Saturday or Sunday, which is the day before both of those days. Okay, so if you have a schedule that's not regular, maybe instead of picking a retirement date right now, you pick a retirement week. And then when you get closer to that time, like if you're in law enforcement or if you're in healthcare, you may have an irregular schedule. And so maybe then when it gets closer to the time, you actually choose your exact retirement date to make sure that you are scheduled to work the day before your retirement date. Okay. And like I said, it's okay to be on leave that day. So this day, you can be on vacation leave, you can be on sick leave, on comp time. It's okay to be on leave. Okay, so I have somebody asking for an example. So in 2023, March 31st is a holiday. It's Friday. Is it okay to retire with work March 31st? What holiday is on March 31st? Am I blanking on a holiday? Okay, so it's Cesar Chavez Day. So I don't think that is that's a holiday that is on the county's calendar. Okay, so it should be, so when I say a non-holiday, it should be one of those holidays that is not on the county's calendar. Sorry, I was not familiar with that. Okay, if it's a Superior Court, if it's a holiday in Superior Court, and that's a holiday, you would want your last day of work to be just go ahead and make your last day of work a couple of days before that, and make your first day of retirement on March 30th, and then you can just avoid that whole scenario. Okay. Can the last day of work be a flex day? Haven't had that question before. I don't know the answer to that. That would be a good question for our staff. So I would write into Acera. If you go to acera.org/contact, you can send us an email about that. And yeah, that is something that I will ask after the presentation. Because I should know that as well. Okay, so now that we know more about what your projected retirement date is that you might want it to be, now you can, kind of put that in pen if you like, for the purposes of this worksheet. And since we know that if you're going to go straight into retirement, that your separation date should be the day before that, you can simply subtract one day and write that day in here. Okay. Okay, let me tell you about the retirement application process and what that's going to look like. So here's kind of the step-by-step on this. Your step one is that we want you to go through the preparing to retire section on our website. I showed that to you a few minutes ago. I can go back to it just so we have a visual aid here. Okay, preparing to retire. And like I said, you can go under members and you can go to preparing to retire, or you can find it on the home page in this preparing to ready to retire menu, prepare to retire. This is in chronological order, so you just start at the beginning and go to the end. You may have already done some of this stuff. Okay, we already talked about verifying your retirement eligibility. Okay, you already know whether you're eligible or not, so that's check. Okay. You already understand how vacation pay affects your pension. Check. You may have already gotten an estimate of your retirement income. Check. You're attending the pre-retirement seminar now. Check. Okay. So there's not going to be a ton of stuff in here, but it is a good idea to go through this stuff. There are documents that we need to have on file and so on and so forth. So go ahead and go through that section as step one. Step two is you're going to set up a ready to retire counseling session. Now you're going to do that in that preparing to retire section, and you're going to do that 3 to 6 months before your retirement date to fully prepare. And so going back to that section, that is the second to last step here, schedule a ready to retire counseling session. And it's a form that you fill out. You fill out the form, we will process it, and then we will contact you about scheduling that session. The session will be scheduled in the 90-day period before your retirement date. Okay. So in 3 to 6 months before your retirement date, you should fill out the form. And then the 3 months before is when we will schedule the session for you in that 3-month period. Okay. Now you need to submit your retirement application within the 90 days before your retirement date. So in that 3-month period, you will also submit your retirement application. You can submit it. We're going to want to have you submit it prior to that counseling session, but your counselor, if you have any questions and you already have most of it filled out, they can help you do the final, do some of the final stuff. But they will communicate with you about that in preparing for that counseling session. And we are getting ready to launch this week our new retirement application, which we've been working on for like a year and a half. And so it's a super simplified version, and it's in DocuSign. It's all electronic. It's super self-explanatory. And so it should be fairly easy for you to go through that new retirement application when you're ready to go ahead and fill that out. And then the final post on that preparing to retire section is walking you through submitting that retirement application. Now, this is about to go away, the option election agreement, because we've combined this option election into the new retirement application. So you will be selecting your retirement option in the retirement application. So you can kind of disregard this step. On your retirement application, you're writing down a retirement date. Once you've submitted your retirement application, we will record your upcoming retirement date in our system. And once that retirement date passes, you're retired. It's amazing. You're going to be retired very soon. And you're going to start to collect that retirement allowance you've been earning your entire career. That's going to be awesome. So, so that's how that works. That is the process for retiring. It's not super complicated. And that like I said, in the counseling session, they'll help you through any of the final preparations that you're going to need to make to retire. So now that you know what the date is to submit your Ready to Retire counseling form on our website, you can just subtract 6 months from your projected retirement date. You could write that in here. 3 to 6 months. Okay, now you can expect your first retirement check within the 4 to 6 weeks after your last employer paycheck. If there's for almost everyone, we will get you right out on 100% payment because we revamped our retirement process a couple of years ago, and 99 point something, probably 0.9% of people these days get right on 100% payments because we've already done the calculations in advance. And that's why we want you to contact us so far in advance, is so we can get that stuff going. Now, if there are any major issues with your file, like a divorce order pending or missing documentation, so on and so forth, we will start you on your retirement allowance. It'll just be 80% payments until we resolve the issues. And then we'll get you up to your 100% payments and issue you any retro payments for any less than 100% payments that we had to make. Okay. So the question is, did you say the retirement option election is going away? That form is going away, but the election will be made within the retirement application. Okay. So it's an all-inclusive form. We've combined like maybe 8 forms all into one retirement application form to make it easier for you. And we've put it in DocuSign. So you can just type it all out, check some boxes, and then electronically sign it. So it's going to be super easy. And we are launching that this week. I know we've had to push it back a few times, but 100% we're launching that this week. I just have to do a couple more things, and that's going to be live on our website either today or tomorrow. Okay. So let me tell you about the retirement allowance option. So this is what we're talking about when we're talking about the option election. You're going to choose one of these 5 options. Okay. At the time of retirement is your opportunity to choose one of these 5 options, and you cannot select a different option later. You can only choose the option on that retirement application, and your option is going to be permanent for your retirement. Okay. But I'm going to help you understand what each one of the options are so you can make the right choice. For each option, I'm going to show you a slide that has way too much text on it. Sorry that I'm inundating you with all the text for each one of these options. But to break it down for you, the top is going to be the title of the option. The top of the table is going to tell you about your retirement allowance as a retiree. And then all of the information below is going to talk about the benefits that are going to be available to your beneficiary or beneficiaries after you pass away. Okay. And I'll just do it one by one, step by step. And so hopefully it won't seem like too much. Okay. First of all, we'll talk about the first option, which is called the unmodified option. This is the option that most people pick because it pays the most retirement allowance to the retiree. That's you. So that's why most people pick it. And yeah, it's the maximum retirement allowance to you. Now, after your death, what this does is it leaves a 60% monthly continuance to a qualified spouse or state registered domestic partner. Okay. So whatever you are making in your retirement allowance, including all of the cost of living adjustments you've gotten over the years, so it's your retirement allowance at the time of your death, your beneficiary, who is your spouse or state registered domestic partner, will receive a 60% payment every month for the rest of their life, which is known as a continuance. So it's called a continuance because it's a continuing payment every month for the rest of their life. Okay. Now, if you are awarded a service-connected disability retirement, that would actually be 100% payment. In order for your spouse or state-registered domestic partner to qualify for the lifetime benefit, you will have had to marry them or register them with the state at least 1 year prior to your retirement date. And then they can get that 60% continuance. If you don't have a spouse or state-registered domestic partner, but you have a minor child or minor children, you can leave them the continuance. But it's a temporary benefit. It's not for their lifetime. It stops, it cuts off at age 18, unless they maintain enrollment as a full-time student in an accredited school, and at which point it will cut off at age 22. It can continue until age 22. As long as they don't marry or register a domestic partner with the state, which will mean that it will cut off. And so this would go to one minor child or multiple minor children. If it's multiple minor children, the 60% continuance will be divided among them. Okay. And then they would each have different stopping points at which point it would cut off. At which their portion would cut off. Now, this part down here, if you don't have a spouse or state-registered domestic partner or minor children to leave a continuance to, you can still choose the unmodified option. A lot of people do that. Don't worry. That's the one that pays the most to you as the retiree. And you can even name a beneficiary. And I forgot to define beneficiary. A beneficiary is somebody who gets your ACERA death benefits. So a beneficiary is somebody who gets benefits. Your ACERA beneficiary is somebody who gets your ACERA death benefits. Okay. So you can name a beneficiary. You can choose the unmodified option, name a beneficiary for lump sum payments, for a lump sum amount, not a continuance. And the lump sum amount you can name to any beneficiary. It doesn't have to be a spouse, domestic partner, or minor children. Okay. But what the lump sum payment is going to be, it's going to be basically the balance of your employee contribution account. So it's going to be all the payments that you made to ACERA over your entire career in your employee contributions, plus all the interest that we've paid to that account, which we do twice a year when we earn money on your money that we're investing, minus all of the retirement allowance we've already paid to you as a retiree. Okay. So when you retire, if you have lump sum beneficiaries, that amount starts decreasing every time we make a retirement allowance payment to you. And that amount will be exhausted within the first 3 to 5 years of your retirement. So if you die within the first 3 to 5 years of retirement, hopefully that doesn't happen. Hopefully you have a long, beautiful retirement. But if that should happen, there will be a balance left in your account to pay in a lump sum to your beneficiary. If you should pass away after that first 3 to 5 years when the account is exhausted, there will be no lump sum balance left in the account, but there will be some other little lump sums here and there left to pay to your beneficiary, including that $1,000 lump sum death benefit I talked about earlier, and probably a partial payment for your last month of retirement allowance, and maybe perhaps a refund of any advanced healthcare payments that you've made. Okay. One more thing I want to say about the unmodified option is that there is a scenario where at the time of retirement, you had a spouse, state-registered domestic partner, or minor child or children to leave a monthly continuance to as a beneficiary, but your beneficiary, after you retire, your beneficiary dies before you do. So should that happen, you can name a new beneficiary, but only for lump sum payments, not for a continuance. Your only opportunity to name a continuance beneficiary is at the time of retirement. Okay. Another scenario that people ask about is you're not married now, but you retire and then you get married later. Can you name your new spouse as a beneficiary? Yes, but only for lump sums, not for a continuance. Okay, so that's the unmodified option. Option number 1 is the only option that does not leave a continuance to any beneficiary at any time. That's why it's called lump sum to beneficiary, because There's no continuance available in option number 1. Now, for your retirement allowance as a retiree, this pays a little bit less than the unmodified option. When you run your benefit estimate, you'll see that it's just a little bit less. What this does is it gives you an alternate option for those people who don't have a continuance beneficiary that they want to name, but they want to perhaps increase the odds that there will be a lump sum left to a lump sum beneficiary. What it does is it increases that 3 to 5 years that there's a balance left in your contribution account to 10 to 12 years. And so it's through a little bit different accounting, but it's like I said, it only pays a little bit less than the unmodified option, but it does leave a balance in there for the first 10 to 12 years of your retirement. Okay. So this is for those of you who still want the kind of the maximum retirement allowance that's close to the unmodified option, but you want to leave, you have only a lump sum beneficiary to name. Okay. Okay, there's a question. Is the retirement payments until I die? Absolutely. That is the beauty of having a benefit from a defined benefit pension plan like a SARA, is that your retirement allowance is a lifetime retirement allowance in all cases. You're going to get paid every month for the rest of your life on the last business day of the month until you die. So that's the benefit that you've earned, that guaranteed retirement income that you can count on. Okay, option number 2. This is called 100% to the beneficiary, probably for obvious reasons that you can guess. Rather than leaving 60% continuance to a beneficiary, like the unmodified option does, it leaves 100% to the beneficiary. So that's the first thing that it does. The second thing that it does is it allows you to name anyone as a beneficiary. It's not just spouse, state registered domestic partner, or minor child. It could be adult children. It could be another family member. It could be a friend. It could be me. I will give you my social security number after this presentation if you want to name me as a beneficiary. Just kidding. So, but you can name anyone as a beneficiary, and that is one of the things that this does. Now, what it does to your retirement allowance is it's going to reduce your retirement allowance. Okay, so if you're trying to be kind to somebody to leave them 100% monthly continuance, what you're going to want to do before, like, hold on. What you're going to want to do is really look at what your retirement allowance is going to be, because typically people are trying to name like adult children who are much younger than them, and then what your reduction is going to be from what the unmodified option is going to be based on the life expectancy of your beneficiary. So if your beneficiary is significantly younger than you, their life expectancy is longer. We expect to pay them for longer. So we are going to pay you less as a retiree. And all of this is calculated at the time of retirement. Okay. So whatever we calculate your option 2 retirement allowance to be, that's what it's going to be for the rest of your life, plus cost of living adjustments, even if your beneficiary dies before you do. We don't recalculate your retirement allowance. Okay. But like I said, you can leave a 100% monthly continuance to anyone. Okay. Unless you want to, one caveat here is if you have a spouse or state registered domestic partner, their right to that continuance supersedes anyone you designate. If you are trying to name under option number 2, somebody who is not your spouse and is more than 10 years younger than you, there is a possibility that you can't leave them 100%. You can leave them some fraction of that, like 80% or something. There's this whole IRS table that talks about how we are supposed to reduce that. You can read more about that on the retire page on our website. And there's actually a link for that in your retirement application to tell you more about that. Okay, so let me see. I have some questions up here. Can the beneficiary still obtain insurance, etc., once the member passes? Yes, as long as your beneficiary is receiving a continuance, they're considered in our system what we call a survivor, and they are eligible to enroll in our healthcare plans as long as their retirement allowance is sufficient to cover. Okay, let me step back here. If they're already enrolled in one of our healthcare plans, they can maintain that enrollment, no problem. If they're going to try to change plans or newly enroll in our insurance, their benefit has to be sufficient to cover the premium for the plan that they're trying to get into. Okay, next question. And I'll talk about healthcare in just a minute. We are running a little behind on time, so we are going to go over about 15 minutes, I think, on this part of the presentation. But I just want to make sure that I impart all the information to you. If you need to leave, if you need to cut out early, feel free to do that. Like I said, we're going to post this video out on our website within the next week, or you could go check out one of our previous videos. It's pretty much the same presentation every time. There's a question: if I was eligible for retirement, but I die before I actually retire, is my spouse eligible for any retirement? Yes, they are. In that scenario, what you would be looking at are not the death benefits that are available to retirees. You would be looking at a different set of death benefits, which is called active death benefits. And if you go on our webpage, acera.org/death, it will detail those death benefits for you. One option that they will have is to get a continuance, and it will actually be based on the unmodified option. It will be a 60%. It will be a 60% continuance calculated on, what we'll do is we'll take your date of death and we will calculate your retirement based on your date of death as your retirement date. So we'll see what your retirement allowance is, and then they would get a 60% continuance of that retirement allowance. So that's how that works. Okay, I do have a question. Why would anyone do that? I think you're referring to option 2. Somebody might do that if they want to leave more, a higher continuance to their beneficiary than under the unmodified option, because you can do that. It's 100% of your retirement allowance. So that's one reason. Another reason is if you want to leave a continuance to somebody other than your spouse, state registered domestic partner, or minor children, because you don't have one of those people, you could leave that continuance to anyone. The same thing goes for option 3. Okay. Option 3 is the exact same as option 2, except it leaves a 50% continuance to your beneficiary rather than 100% continuance. And so because we're paying less to the beneficiary in option 3 than option 2 pays more to you, the retiree. So if you look at your benefit estimate, option 3 is going to be higher than option 2. Okay. But everything about option 3 is the same as option 2. This part, we actually just calculated this part about it being sharp. That whole thing that I told you about, if your non-spouse beneficiary is more than 10 years younger than you, the IRS will reduce your benefit. That won't happen under option 3. 50% is already underneath the IRS's lowest limit. So you don't have to worry about that for option 3. Okay, then let me see. I have some questions. So the option that I pick will affect my monthly pay. Absolutely. Because the unmodified option pays the most. Option number 1 pays almost as much as the unmodified option. And then options 2, 3, and 4 are going to be based on the life expectancy of your beneficiary. And then there's another question. Oh, yeah. So, and this is a follow-up to why would I do that? If your life expectancy is quite low, that would be a reason that you might pick option 2 to name a continuance, a lifetime 100% higher life continuance to a beneficiary. Yeah. And then option number 4 is very similar to options 2 and 3. Okay. It leaves a continuance, lifetime continuance to anyone. It pays less than the unmodified option, but in this case, you specify the dollar amount or the percentage to one or more beneficiaries. So you can have multiple beneficiaries in option 4. If you have 2 adult children, you could name them both for a continuance, lifetime continuance. And let's say that you want to leave them 100% continuance. Well, you would divide the 100% between the 2 of them, 50-50, or however you want to divide it. Or you could have, if that is going to reduce your retirement allowance by a lot. Okay, maybe you want to leave them a lifetime continuance, but a lot less than that. So maybe you only want to leave them at 20% continuance, and you'll take that 20 and divide it evenly among the 2, 10% and 10%. Or maybe you have a nephew, you don't have any adult children, you have a nephew you want to leave a continuance to. You can pick any percentage. You could leave a 10%, 20%, 50%, 40% to that person. And we're just going to calculate your retirement allowance based on reducing it from the unmodified option based on the life expectancy of the person or persons you choose. Now, that IRS reduction does apply to this. So if you're trying to leave like an 80% continuance to somebody who's more than 10 years younger than you and is not your spouse, then you may not be able to leave that much. But the retirement counselor will help you through that, navigate that. Now that is the options in general. Specifically, what will the options provide you? Well, you can estimate that by doing the benefit estimate. So again, this is a screenshot of our estimator. What you're going to want to do is do the estimator, make sure that the beneficiary information is correct in here. If you select your beneficiary from the dropdown in here, because you've already designated your beneficiary for active member death benefits, make sure the date of birth is correct. If it's not, some of them are correct and it will throw off the calculations. And you hit get estimate. And when I zoom in here, now these options probably make a little more sense to you. Okay, the unmodified option you'll see pays the highest. The option number 1 pays a little bit less than the unmodified. You'll see that the beneficiary allowance for the unmodified option is going to be 60% of the member allowance. You'll see that option 2 pays the same amount to the member, you, and the beneficiary. You'll see option 3 is larger than option 2, and it pays 50% of the option 3. So this is how you know what each of the options are going to pay, so you can make your informed decision when you're choosing among the options. Additionally, option number 1 gives you these two numbers, which kind of helps you get a ballpark of how long this balance of your account is going to last, because this is the monthly amount that's going to come out of it in annuity. And so what I used to tell people is you can divide the big number by the little number and it will tell you how many months that is going to last. But now I found out that it's also going to subtract cost of living adjustments. And that's complicated because it deals with compound interest. And so it's hard to tell exactly how long that will last. But like I said, it should last 10 to 12 years. Okay. You'll notice it doesn't give you the opportunity to see an estimate for option 4 because the math, there's so many different iterations that we have to send it out to our actuary to calculate. If you want an estimate for option 4, you can get that at the time of retirement. You just talk to your counselor about that. Okay, now let me talk about healthcare benefits. We are running a little behind time, like I said, but I do want to give you the full information on this. Okay, so let's see if Jean has joined us yet. Okay, so yeah, Jean Hilliard from the Deferred Compensation Program has joined us. We are running about 15 minutes behind Jean, so hopefully you have a little time to bear with us on that. Let's talk about the healthcare benefits. So healthcare benefits are not guaranteed. I mentioned guaranteed benefits earlier. I showed you a list. Healthcare was not on the guaranteed benefits. These are non-guaranteed benefits. They're extra benefits offered by the county and your employer. And they started a reserve fund to pay for these benefits. Our Board of Retirement determines what the benefits are, what the levels of benefits are, and their whole goal in determining what the benefits are and those levels of benefits is to ensure sustainability of the fund that pays for these benefits so we can continue to offer these into the future. Now, having said that, there's $1 billion in this reserve fund to pay for these benefits. So these are this fund is considered quite sustainable, and these are going to be offered, into the future. Okay, that reserve money has to be paid out to benefit retirees. Okay, but like I said, it's non-guaranteed, so just be cognizant of that. It's not vested. It means guaranteed. This is non-vested. This is not guaranteed. Okay. Here are what the non-guaranteed benefits are. There's medical subsidy, which is known as the monthly medical allowance, dental and vision subsidies, Medicare subsidy, and supplemental cost of living adjustments. And what I'm illustrating in this chart is that the minimum qualifications for qualifying for these benefits are set up by the Board of Retirement in order to ensure that the fund is sustainable. So for most of the benefits, they start at 10 years of ACERA service credit in order to qualify. And that's not including reciprocal credit. That is ACERA service credit only. Okay. The supplemental cost of living adjustment is the only one that everyone has access to, regardless of how much ACERA service credit you have. And then there are a couple more levels of the monthly medical allowance. Let me talk about each one of these in some detail. Okay, first of all, the medical subsidy. This goes to help you cover the cost of being enrolled in one of ACERA's medical plans. It's not guaranteed, like I said. It offsets the cost only of ACERA-sponsored retiree medical plans. If you go outside and get your own medical plan, you can't use the monthly medical allowance. For our group plans, it helps you cover the cost of premiums only. For our individual plan options, it helps you cover the cost of premiums, copays, and deductibles. The dollar amount is set annually by ACERA's Board of Retirement. In fact, the Board of Retirement looks at every one of those benefits annually and sets the levels annually to ensure the sustainability of that fund. You, the retiree, are responsible for any costs of the healthcare premiums and other costs exceeding the monthly medical allowance amount. And it's not for others in your family, it's only for your costs. It doesn't go for your beneficiaries' costs, survivors, former spouses, dependents, anyone else. You can enroll them in the plan, but the subsidy does not cover their expenses. Okay. But in so much as they're part of your family and your expenses are their expenses, it reduces your expenses. Okay, so here are the amounts for 2022. The full monthly medical allowance is available to you if you have at least 20 years of ACERA service credit, and that pays $596.73 per month. If you have at least 15 years of ACERA service credit, you're eligible for 3/4 of that amount at $447.55. If you have at least 10 years of ACERA service credit, you're eligible for $298.37, which is half of the full amount. Excuse me. Now let me show you what the premium amounts are to show you how much currently those monthly medical allowance dollars will pay for. And I'll show you the premiums for our plans, and I'll show you what the plans are, what the plan options are. Okay. So first of all, our open enrollment is every November. So that's your opportunity to change medical plans. But going right into retirement, that's a qualifying event. You can go right into one of our medical plans without a gap in coverage. Our healthcare unit helps you do that at the time of retirement. Okay, so don't worry about that. Now we have two kind of categories here. We have non-Medicare eligible plans, which are that means that you are not Medicare eligible because you are under age 65. You're Medicare eligible once you're over age 65. And so if you're Medicare eligible, you're choosing from the Medicare options. If you're not Medicare eligible, you're choosing from the non-Medicare options. And you can see that there's 3 companies: Kaiser Permanente, United Healthcare, and Via Benefits. Okay. I'll tell you about these. What I'm going to do is the group plans first. So the non-Medicare group plans. Then I'll talk about the Medicare group plan, and then I'll talk about the Via Benefits individual plan options combined, because it's more efficient to do it that way. I'm just showing you kind of the costs and the names of the plans. If you want the full plan details, you should check out our annual enrollment guide by going to acera.org/guide, and we publish this every year, and we mail it to you every year in October in your open enrollment packet. Okay, first of all, we're talking about non-Medicare group plan costs. Okay, so these are for if you live in the California service areas for these group plans, and you can see what the self premiums are here, and the self plus one family and the copays. You can see that the United Healthcare Signature Value Advantage HMO is the cheapest plan at $781.42. Kaiser Permanente HMO, a little bit more expensive, the Signature Value Plan is about 6% cheaper, and it's at $88.43.16. And then the other one, the Signature Value HMO, is a little more expensive, kind of a lot more expensive. And the difference between these two United Healthcare plans is that there's this high-performing network of providers that you have to stick to that is available to you in this plan, this cheaper plan. When the county studied this, they found out that almost everyone enrolled in the more expensive plan was already going to the cheaper, the high performing providers. So they should just enroll in the cheaper plan anyway. So that's my little pitch for that. And one more thing I wanted to say about that. Okay, you'll notice that none of the monthly medical allowance amounts cover the full cost of any of those plans. Okay, so you will end up owing more, you will end up having to pay the difference. And the way that you pay the difference is in your Acera check. This is a super crude illustration of your Acera check stub that you'll see from your monthly retirement payment. Okay, here's your gross pay in this example, $4,000. Here's the deductions column. This is non-taxable income, so this is before tax deductions. If you sign up for the Kaiser HMO, you see $843.16 coming out of your check in the deductions column. And then you'll see your monthly medical allowance amount that you're eligible for going back into the same check, $569.73. In this example, they have a 20-year monthly medical allowance, and you end up paying the difference out of your retirement check. Now, there will be other deductions here for taxes, withholding and stuff. But this is just illustrating how the monthly medical allowance payment works in regards to the medical plan. Okay, let me just double check on the questions here. Okay, there's one question. If my spouse has 15 years and I have 20 years, is it prudent to buy self plus one for me or two separate health policies? When you say that, it sounds like you're both Acera members, and one of you and your spouse has 15 years of service credit and you have 20 years of service credit. If that's the case, you should buy separate plans. You should enroll in separate plans because that's the way you can both utilize the monthly medical allowance that you've earned. Otherwise, if you were in the self plus one, you would only get one monthly medical allowance. Okay. Okay, I'll hold on to that question for a minute. Okay, I'll hang on to that question for a minute. Will the monthly medical allowance pay if I go outside California? Yes, if you enroll in one of our individual plans, which I'll get to in just a minute. And then the question is, so the monthly medical allowance is over and above your retirement benefit? Yes. It is a non-guaranteed extra benefit. So you get your retirement allowance, as in the previous illustration, you get your whole retirement allowance, and then on top of that, you get the monthly medical allowance. Okay, and that is not taxable income, the monthly medical allowance. So additions would be, I don't know what the categories it falls into, but all of the subsidies are non-taxable is the bottom line. Okay, so then we have our group Medicare plan. We have one group Medicare plan. So once you become Medicare eligible, what you do is you enroll in Medicare, the federal government's healthcare payment system. Okay, and then there are all of these companies that offer these plans that work with Medicare, but give you a higher level of coverage, such as this Kaiser Permanente Senior Advantage plan, which is a Medicare Advantage plan. Okay, again, this is for the California service areas. And for all of these plans, the California service areas are the Bay Area, Sacramento, Fresno, Southern California, and for Kaiser, Santa Cruz also. So if you live outside the California service areas, even in California, you're going to be choosing one of our individual plan options. And if you live outside California, the same thing, one of our individual plan options. Now you can see that the premiums are a lot less because for the Kaiser Permanente Senior Advantage plan than they were for the non-Medicare plans because the federal government is footing the bill for most of the costs of your coverage. So if you have at least 15 years of Acera service credit, your monthly medical allowance will pay for the full premium of your Kaiser Permanente Senior Advantage plan. One thing that I want to point out here is I've given you some extra numbers here. I've given the example of the 20-year monthly medical allowance. And to show you what your out-of-pocket cost would be, I've done this to illustrate that the monthly medical allowance only pays up to the amount of the premium for the group plans. It does not pay over that. You do not get to keep the change. Okay, that is why in this example, the self premium is $344.44 and your monthly medical allowance is $344.44. But that means your out-of-pocket cost is zero. Okay, so that is a good thing. And yes, again, monthly medical allowance amount is not taxable income. How does the monthly medical allowance amount differ if I retire with a disability retirement? Um, Good question. I'm gonna pause real fast to answer that. Let's see. So if you're service-connected disability retirement, you automatically get the 20-year, the full monthly medical allowance for you. So that's how that works. So you don't have to worry about years of service credit. If you do have a service-connected disability retirement, then you are eligible for the full monthly medical allowance. I just needed to double check that. Okay, so I've talked about the group plans. So I'm going to kind of move ahead with this. Oh, and there's a question for the group plans. Will I still be covered if I live out of state a few months out of the year? Yes, the standard for the group plans is you live in the service area for at least 6 months out of the year. And then 6 months at a minimum. So if you're out of the state for a few months, you can have emergency care out of the state. And then when you come back to the service area, then you can have your regular appointments with your doctor. And the question is, what if I don't want Kaiser and I want to continue with United Healthcare? If you are younger than age 65, you can pick one of those United Healthcare plans. If you're older than age 65, what you can do is you can get an individual United Healthcare plan through Via Benefits, which I'm about to show you. Let me explain Via Benefits individual plans. First of all, who can enroll in an individual Via Benefits plan? So Via Benefits, what they are is they are an independent health insurance exchange. They contract with 100 different providers to provide like 1,000 different plans to our members. And they connect you with an individual plan that meets your needs. Okay, so who can enroll? If you are not yet Medicare eligible, you must live inside the US, but outside one of Acera's group plan service areas. And that allows you to enroll. If you are Medicare eligible, you can live anywhere in the US. And all you have to do is enroll in Medicare Parts A and B, and then you can find a plan. So that's what I was referring to when I said you can find the United Healthcare plan. If you're Medicare eligible, you can find United Healthcare plans inside Via Benefits. They contract with United Healthcare to offer individual plans. Okay. So like I said, the service area is nationwide. The enrollment is over the telephone or online. If you talk to them on the phone, you'll talk with a certified, non-commissioned, salaried advisor. They're not biased. They're not going to, they don't care which provider you go with because they're not getting a commission. They're going to help you find the plan that's right for you. When you call them, you can tell them where you live or where you're going to live. You tell them how much you want to spend, what level of care you want to get. And so this is going to answer that question at the top of the board, how you can select Medicare medical care out of state. If you want to pick the richest plan that has the highest benefits, but is maybe a little more pricey, they have those plans for you. And so if you want a little bit less of a plan, less costly plan, they have those plans for you as well. You can even get as granular as which providers you want to visit, which prescription drugs you need, and they'll help you find a plan. Okay. And like I said, the monthly medical allowance for that not only will pay for the monthly premiums, which is the monthly cost of being enrolled in a healthcare medical plan, but the deductibles and copays as well. If you have a deductible plan, and also you'll probably have copays because most plans have copays. Now, the monthly medical allowance works a little bit differently for those Via Benefits individual plans. Okay. It's not paid into your retirement check. We don't take premiums to pay for your cost of coverage out of your check. That works differently. Here's how it works. I have the second crude illustration to illustrate your finances. So here is Acera. Let's say that you are eligible for a monthly medical allowance, okay? And you want to enroll in an individual plan through Via Benefits. Well, what Acera is going to do is we're going to take your monthly medical allowance that you're eligible for, and we're going to send it over to Via Benefits. They're going to put it in a health reimbursement account for you. So they're going to open a health reimbursement account for you, and they're going to put that monthly medical allowance in there for you. and it's going to wait there for you. Okay, now you are going to have a bank account, and you're going to pay monthly premiums directly to an insurance company that Via Benefits helps you find for the cost of being enrolled, the monthly cost of being enrolled in that plan. So you're going to be out some money from your bank account. Okay, then presumably you're also going to go to the doctor and use your plan, and you're going to pay a copay. So now you're out some more money from your bank account. What you're going to do is you're going to submit a reimbursement claim to Via Benefits, and they're going to pay you your monthly medical allowance amount that you have coming to you to reimburse you for the costs that you had to pay for your coverage. Now, you can set up a lot of the stuff to happen automatically. Recurring automatic payments for your premiums, recurring automatic reimbursements to your account. They'll help you set all that up, and you'll just be responsible for submitting individual reimbursement claims to your doctor. One more thing I want to say about the Via Benefits plans, just the Medicare plans, is they are so much, they cost so much less than the group plan that they replaced, and they're so inexpensive that the Board of Retirement decided to have a slightly lower set of monthly medical allowance amounts just for those Medicare plans that are gotten through the Via Benefits healthcare exchange. And so you can see what they are here. Okay, let me check the questions. So before I reach age 65, will I need to apply for Medicare from Social Security Administration? Yeah, before you reach age 65, the 3 months before your 65th birthday is a good time to apply. What I recommend doing is going to our Medicare transition seminar. I'll show you where to sign up for that. You go out to our website, go under news and events, and right underneath retirement planning seminars where you sign up for this, you can sign up for our Medicare seminars. And it's a good thing to do right before you, maybe like 6 months or 4 months before you turn 65, and it will help you transition into Medicare. Or you could just watch the video of the last one we recorded. And then if I only do 5 years vested service time with the court, how much average percentage of medical will I be entitled to, if any? There is no medical subsidy for you. So yeah, sorry about that. You have to have at least 10 years of ACERA service credit to qualify for the lowest level of the medical subsidy. But you can still enroll in the medical plans if your retirement allowance is sufficient to cover the premium amount for the enrolling in the medical plan. And then there's a question, do I choose medical coverage if I'm covered medically by my spouse's employer? That's up to you. So if you want to stick with your spouse's medical coverage, you can do that, especially if they're paying the full amount for you. You may want to just go ahead and do that. But you can't use the monthly medical allowance to pay for any of the cost of that. So alternatively, your spouse could keep their coverage, and then you could get your coverage through ACERA. And if you're enrolled if you're eligible for the monthly medical allowance, then you could use that. So that would be up to you. And then if you change your mind in the future, November is open enrollment, you can change plans, or if your spouse retires, that's a qualifying event, you can change plans then. Okay, so you have different options going forward. And then let's see. There's a question, if I worked for Diversified before the county had TAP, can I buy back that time? Probably not. That's a temp agency, I think, or an employment agency, and that's not purchasable. Okay, and we already answered that top question. Let me tell you about dental plans. Okay, so we're nearing the end. I'm going to tell you about dental, vision, Medicare Part B reimbursement, supplemental cost of living adjustment, 1 or 2 more things, and then we'll be done. Take me another, I don't know, 6 or 7 minutes. Okay, if you have at least 10 years of ACERA service credit, when you retire, you must enroll in a dental plan. However, it does not cost you anything. It costs you $0 out of pocket because the subsidy amount and the self-premium amount are the same for both plan options. There's 2 plan options. Delta Dental PPO is national. Delta Care USA is California only. And yeah, you have to choose a plan, but it costs you $0. And you can also enroll Self+1. And what you would see if you did that is you would see 85.96 come out of your check and 44.15 go back into your check as a subsidy, and you end up paying the difference. And the same thing with the family enrollment. If you have less than 10 years of Acera service credit, there's a different set of premiums. You don't have to enroll, but you can enroll voluntarily. Okay. And like I said, go to acera.org/guide and you can see everything that the dental plans cover. And it's pretty good coverage. Now for the vision plans, it works very similar. If you have at least 10 years of Acera service credit, you have to enroll in at least the VSP standard plan, but it costs you $0. So $3.97 is the subsidy amount and the premium amount. Now you can buy up into the VSP premium plan, but your subsidy is still going to be $3.97 per month. So you end up paying the difference. And then, like I said, you can voluntarily enroll with less than 10 years of Acera service credit. And there's a different set of premiums for you. The difference between the standard and the premium is outlined in that enrollment guide. One difference is you get frames every 12 months rather than 24 months. So there are some decent differences in there for buying up into that plan. Medicare Part B reimbursement plan is another one of these non-guaranteed benefits. What this does is it offsets the cost of being enrolled in Medicare Part B. So whenever you become Medicare eligible and you enroll in Medicare, you're going to enroll in Medicare Part A hospitalization coverage, Medicare Part B doctor's coverage. Sometimes you'll enroll in Medicare Part D separately, which is prescription drug coverage, but sometimes not. Sometimes that's wrapped up in your primary plan. And they're going to start charging you if you've already paid into the Medicare system for 10 years, Medicare Part A will be free, but they'll start charging you Medicare Part B, and there will be a monthly cost. Now, what the MBRP plan does is it offsets the lowest cost that any of our members pay. There's different income brackets for the costs, but the first bracket is pretty high. And so the vast majority of our members pay the lowest amount to Medicare. For 2021, it was $148.50. For 2022, sorry, I didn't update the slide. I can tell you what it is real quick. It's $170.10 for 2022. And so that's the cost that you pay to Medicare, but that's also the subsidy that you'll see in your check. If you make sure that you submit a MBRP form when you become Medicare eligible and enroll in Medicare Part B. Okay. And so you just have to have at least 10 years of Acera service credit to qualify, or a service-connected disability retirement, and just have to enroll in Medicare Part B. And like I said, go ahead and go to one of our Medicare transition seminars, and that will really help you. There's a big discussion of Medicare, and we talk about this reimbursement plan. And so I highly recommend it. It's not very long. It's less than an hour and a half. And then finally, the last non-guaranteed benefit is the supplemental cost of living adjustment, which is on top of the guaranteed cost of living adjustment. They're two separate cost of living adjustments. And this keeps you at least 85% of the buying power you enjoyed at the time of your retirement. So if inflation ever gets so bad through the years that you lose 15+% of your buying power, the supplemental cost of living adjustment kicks in and keeps you at 85% of your original buying power. So you can't lose too much. Your buying power can't erode too much to inflation. Really quickly, let me tell you about these different life events that I want you to be cognizant of. I don't go into detail about these because they don't necessarily apply to everyone. If you defer your retirement, you stop working and you retire at a later date, which is quitting before retirement, you're becoming a deferred member with Acera, go ahead and read our deferred retirement page because there's information for you there. If you want to know about death benefits before retirement, go to acera.org/death. If you want to know about how divorce or domestic partnership dissolution affects your Acera benefits, which it can, because your Acera benefits are community property in California. So those could be divided in the event of a divorce or a domestic partnership dissolution. Go ahead and read our divorce page at acera.org/divorce. If you become permanently disabled and you can't perform your job duties, you could retire early under a disability retirement. And so you should go ahead and read our disability retirement page, which is acera.org/disability-retirement. If you're going to work after retirement and you're going to work anywhere but one of our participating employers, that's beautiful. Feel free to do it. I mean, if you want to, you can do that. If you don't want to work after retirement because you're done working, that's really beautiful. So don't work after retirement. Just, sit back and collect your check. But if you do want to work, maybe you want to work part-time somewhere, totally fine. We're going to consider you an ACERA retiree from your date of retirement, and you're just going to get your lifetime retirement allowance. And you can go, get some kind of side income if you like. Unless you try to come back to work for one of ACERA's participating employers, and then there are restrictions and duration limits. So you're going to want to read about that on our webpage. If you relocate after retirement, that could affect what healthcare plan you go into. And we also want you to update your address with us so we can continue sending you your open enrollment packet and annual report and other official correspondence. So we do want you to update your address with us. And we do recommend you signing up for ACERA News to keep track of the important information we send out. We only send out important stuff. So if you go to acera.org/subscribe and you subscribe to our news, you'll probably hear from us once in a blue moon. You're not going to get inundated with news, but if it's important, we do send it out. And if you have more questions at any time, feel free to contact us at acera.org/contact, and there's an email form there, or you can call us at any time, 510-628-3000. And that's during business hours and, of course, not on holidays. All right. So on behalf of the ACERA Board of Retirement and on behalf of ACERA staff, we wish you a beautiful retirement. So we hope it goes extremely well for you. We wish you a beautiful rest of your day and a beautiful life. So thank you very much.